To go into the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Silicon Valley Bank plunges 60% as the startup lender struggles to restore confidence in its financial health. The move drives the biggest slump in US bank shares since 2020. Traders dump stocks and buy bonds as concern about the US banking sector sparks fears of broader economic distress. Plus, we get the payrolls report later today for February. We will be watching for direction in terms of the Fed's rate hiking path.
Tom, if you look at the futures, so they're really on tenterhooks trying to find these pockets of U.S. financials where we could see more stress. And again, I think it's one of the first times we're really seeing since this broad interest rate move, the fact that this could, start impacting parts of the market. So the FTSE futures and the DAX futures down 1.5%.
Yeah, and as we said in the headlines, the context, of course, the pressure on the banking sector in the US, whether there is a read across to the European session today, of course, the KBW index in the US fell to almost the lowest point in 3 years. Almost $50 billion wiped off the valuations of the largest banks in the US. Goldman Sachs coming out and saying that the risks around contagion from smaller lenders to largers is remote at this point. But there's a key question now for investors. Is this a minor fissure that can be papered over in our financial system, or is it a dam that is about to burst? Across the FTSE 100, you're seeing losses then of 1.2%. And of course, we'll dive into the banking sector shortly. Losses then 100 points across the FTSE 100. The Spanish IBEX down by 1.6%. And over in France, losses of 119 points down, 1.6% on the CAC 40. Let's switch it over then and see how things are playing out. The losses, of course, of yesterday pronounced on Wall Street after some earlier optimism about the jobs picture. We look ahead to the non-farm payrolls later today, of course. Here in the UK, the economy growing at a slightly faster clip than many economists had expected in January. And then, of course, Kuroda is coming through, holding policy on pat at his last meeting. Across the banking sector then here in Europe, losses of 3.6%. So the pain is being felt across that benchmark. The financial services sector down 1%, and we continue to keep an eye on what is happening in the yield space. The yields off dramatically in the US across the curve, 2.59, 2.5 on the benchmark 10-year. That's a move of 14 basis points lower. The UK gilts 10-year, 365, 13 basis points move lower on the yields. Fran.
Yeah, so not surprising, it's really the banks that are getting slammed in today's trading session, although they were down by about 2.5%, and now they're only down by 1.5%. So there is a little bit of movement, certainly at the top. I don't know whether it's financial services in general that we need to keep an eye on, whether it's specific ones that actually investors think they have some kind of exposure to Silicon Valley Bank. For the moment, so 1.9% for the banks. Actually, the loss is now deepening, down 3%, so we'll see exactly how we settle. And again, we're trying to figure out the exposure that Silicon Valley Bank has to other parts of the market in Europe. Now, this is a lender that is little known outside tech circles. It sparked a wave of panic that has dragged down banking shares around the world. It comes after SVB announced a surprise $2.25 billion share sale. Now, meanwhile, the bank's top executives have urged calm. Earlier, we spoke to prominent investor Mark Suster, who warned against overreaction.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies. All throughout the global financial crisis, depositors were made whole.
Let's bring in Bloomberg's Danny Berger, who's been, of course, all over this story. So, Danny, we can't panic. We can't also not make much of this. So what exactly is going on at SVB?
Fran, if you put it really simply, it is what we always talk about, the unintended consequences of higher rates and the potential for something to break. That is kind of precisely what happened here. To get more into the detail, because that is putting it very simplistically, SVB, like all other banks, are able to hold bonds on their balance sheet. And they can say on their balance sheet that they are worth at cost. They're worth what they had originally bought them at. Of course, that's no longer the case, especially for long duration bonds, which SVB had a lot of. So when you have a panic, when you have VC funds not doing well, they need to take money out, like we have been seeing recently, the issue becomes what happens when you need to liquidate those bonds. SVB at the end of last year said they were worth $91 billion. It's very highly likely they're not actually worth that because the Fed has been hiking rates. So you have this mismatch, and that's how you get this run on the bank potential and the wider fears of does it spill over into other banks.
And that is the key question, isn't it? You look across the banking sector right now, losses of 4.2%, Danny. What is the contagion risk? How significant is this potentially?
Well, we don't know the equity holdings of some of these other banks, but it is very possible that they hold some of their peers, hence why they're all selling off together. Now, a lot of the sell-off has been concentrated in banks that have those, they're called held to maturity, that label on their balance sheet of their bonds, so Schwab, for example. So it's clear that that is where the fear are, but we have to remember with Silicon Valley Bank, it's very exposed to VC, it's very exposed to high net worth individuals, so it's a very different type of clientele than a lot of these other banks would have. So that spillover effect might not be quite as strong. Of course, as I was talking to Andy Brenner from that alliance earlier, it could mean that the Fed tries to back off and becomes more cautious.
Okay, Bloomberg's Danny Berger on the details around SVB. We're going to stay with the story, of course. Joining us now is Shruti Gandhi, founder and managing partner at Array Ventures. Shruti, good morning. Thank you for joining us. Good evening from where you are, of course. Really appreciate your time. What is your level of concern at this point, and what has your message been to your portfolio companies, to your founders?
You know, it is scary. You know, you wake up with one message and then over the day, things progress quite crazy in terms of the news we were hearing. And then there was a lot of comparison between the recent blowups we've had in the market. So there's a lot of fear out there. But what we did tell our portfolio founders is to do what I would tell in any situation, which is to basically hedge and diversify. I'm not worried about Silicon Valley Bank at the moment and our deposits there. Silicon Valley Bank feels, so basically Silicon Valley and is part of the integral part of the startup ecosystem here. For them to really be in trouble here, a lot would have to go wrong fast. But for our founders, what I told is basically start the process of opening other bank accounts and, just kind of be prudent about that. But it's not time to panic just yet because that would cause a lot of chaos, unnecessary, KYC ML issues. Transferring money into different bank accounts without proper regulation last minute is not something that is ideal and not something that the CFO can track well down the road. So I do not want our founders to just create frenzy just yet.
Yeah, and Shruti, I guess you're right to approach it with caution. We've had some big groups saying, look, this is the right time to get out. Others saying, let's wait and see. You make a good point that actually some of the smaller companies don't necessarily have a second bank account. So even if they were to take their money out, it's difficult at this moment to see where they put it. What will be the longer term implications of this in terms of access to capital for some of these smaller companies?
I think my sense is that the liquidity that SVB has is not going to be impacted in terms of being able to take your capital out. Also, you're insured for up to $250K. And, it's also generally wise. A lot of our founders have also put capital anyway in the sweep accounts, money market. So that actually has higher protections as well. The overnight sweep account is where your money goes away for the night to begin with, and it is off the balance sheet to begin with. So, there is no reason for founders to keep a certain amount of capital, millions of dollars, just sitting in the bank account, especially in the markets we had in the last few years with low yields. So we were advising our founders to create a series of smart moves for the excess capital they had. And in this market, a lot of our founders should be acting with the same kind of rationale. Like, do not have a lot of money sitting around that is not working for you. So I think in that sense that many of the founders are in some ways not worried about being able to not access that capital.
The VC markets, which, as you well know, had already been in something of a winter as a result of the higher rate environment. Are we seeing a deep freeze now in terms of VC funding? Is that market essentially closed, at least for the next 6 to 12 months, at least until you get a pivot from the Fed?
It's a great question. So I think it matters what stage we're talking about. The later stages have certainly seen a lot of drop in the amounts of valuation, funding, activity, and so forth. But the early stage, which is the pre-seed, first few rounds, first check ever into the company, actually has not slowed down, primarily because of a lot of buzz around generative AI, trends, data, AI, ML, things that Array Ventures actually invests in as well. And so for that reason, there's actually, that's one of the reasons. The second reason actually is a lot of the larger funds are now spending time in the early stages as well, because later stage activity has slowed down. So they have raised a lot of money in the last few years. So for them to actually deploy and remain active, they've also moved a little bit at the earlier stages. So that has actually creeped up and affected the market in a way where valuations have not been affected as much in the pre-seed stages. I think the other thing that has happened is the public markets have been a little bit more volatile and not just in going down in one direction, which has given a lot of early stage founders hope, maybe false hope, but hope that things are going to correct and come back soon. So the valuations at the pre-seed stages have not been affected, but later stages definitely yes.
Shruti, thank you so much for all of the insight. Shruti Gandhi, their founder and managing partner at Array Ventures. Now, this was an extremely important conversation, looking, of course, at some of the funding through some of the startups in Silicon Valley. We also know that Silicon Valley Bank does service some UK clients. The other question is Wall Street pondering a crisis. So if you look at the share price for a lot of the banks, and I don't know whether we have that board, but let's bring it up if we do, is the fact that a lot of people now are asking across the industry, is this just the start of a much bigger problem? So we know they've been recapitalized. Remember, we don't want to create too many parallels between 2008, but because we've lived through 2008, a lot of the bigger banks have very stringent rules in place. The fact that we're looking at Deutsche Bank down 8.5% today's trading session means that there are concerns out there. Not only the, legacy issues or some of, I guess, the interplay with the SVB, but also what they have in their own books and maybe how they're pricing some of these bonds.
Yeah, and part of it was a concern about deposit rates and not being able to match the competition. So some of these founders and SVB and others pulling their money out in terms of deposits, they can put that into treasuries, get a higher yield. Then there's competition from other players as well. So that is a pressure point, and we'll see what the read across. Again, Goldman Sachs saying that the contagion risks from small to large are remote, and we know that regulators, particularly in the US, have greater scrutiny on the larger banks.
Right, and I think that the only question we need to ask ourselves almost is how much do these banks have, of course, some of these interest rates or interest bonds that cannot be sold in a hurry without losses. So we'll have plenty more on that. Coming up, Silicon Valley Bank, as we just heard, descending tremors through the global banking sector. We'll bring you more on that market reaction next. This is Bloomberg.
Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 15 minutes into the European trading day. Heavy losses of 1.6% across the benchmark. The focus on the banking sector currently down 4.7% on the back of the turmoils linked to SVB Bank, Silicon Valley Bank in the US. Fran.
Now, for market reaction after the Silicon Valley-based lender took steps to shore up its capital position, let's get straight to our report to Valerie Teitel. Valerie, I mean, the crux of the matter is basically banks are holding on to things that we don't exactly know how they price, and if they sell them in a hurry, they'll take a loss.
Exactly. Do we see this kind of deposit flight that hit Silicon Valley Bank? But let's take a look at how the Asian banks performed overnight. They were vulnerable to this move. The Bloomberg Asia Pac Bank Index falling over 2%. Topix banks, that's banks in Japan, falling over 5%. Some of that had to do with the Bank of Japan being on hold, but still a slide of 5% in Japan. ASX, that's banks in Australia, down nearly 3%. And Hang Seng, banks in Hong Kong, down nearly 3% as well. We are seeing some follow through in the Russell 2000 future. That's the small cap future for the U.S. A lot of the regional banks, U.S. regional banks are in this index. It fell nearly 3% yesterday, falling through with another 1% so far in this session. This flight to quality is causing a bid to treasuries, and geez, that is catching the market offside. Two-year yields have now rallied nearly 30 basis points in 48 hours, Francine. It's been quite a squeeze in the front end. This comes after 3 days ago when Powell mentioned that 50 basis points is on the table for that March meeting. We've nearly retraced all of it and then some. The move in the front end has really been catching the market offside. A lot of people were positioned short in treasuries expecting a hot payroll print today, and boy, they've gotten stopped out.
They certainly have. Valerie Teitel on the market implications then across particularly fixed income. You're looking at the front end, as you say, 4.79 on the US 2-year, and moved lower by 8 basis points in terms of the yield following the squeeze on yields that we saw yesterday. German bonds rallying as well, an 18 basis point move lower in yields there as money moves into German debt, 3.094 on the front end. Let's bring in at this point Bloomberg's currency and rate strategist Ven Ram for the consequences, the implications. Then, what a big day for these markets, particularly across the debt markets. Why? Let's start with SVP, the linkages between the trouble, the travails of SVP and these debt markets.
Morning, Tom. Yes, obviously the markets are jittery because, this can snowball. They're wondering at this point whether this could snowball and morph into something bigger than what it is. At this point, all we know is that, the principal investors in Silicon Valley Bank, or the ones who are primarily exposed to this, i.e. the venture capital funds. If it's just about the venture capital funds, I don't think the policymakers are going to jump in and say, look, let's bail out SVB, as Pershing Square founder Bill Ackman has been saying. But the concern for the markets here is there something bigger going on? Is there a systemic risk? And that is why the markets are jittery. That question about systemic risk is all we need to focus on.
Right, and this is the $1 million, $1 trillion question, Ven, right? A lot of people are asking, who's next? And I don't know whether you think this is an existential threat that could blow up very soon, or whether it just means that a lot of the banks will have to pay a higher premium so that there's, so that people keep the deposits with them. So this is an earnings story rather than an end of the world story.
No, definitely this is not an end of the world story. It doesn't look like at this point anyway. The question is, these intermediaries typically lend out multiple times the money they borrow from depositors, all predicated on this one major assumption that when the depositors won't all demand their principal back at the same time. When they do, no matter how sound their balance sheet is, and we know that the balance sheets are vulnerable because of the investments in bonds at a time when interest rates are rising, and that is why there is this acute trouble that SVB is facing. But at this point, there is no indication that other banks and other intermediaries are in a pretty similar situation. Yes, they're all copying losses on their mark-to-market portfolio, but otherwise, I think this is a well-telegraphed interest rate hiking cycle. So many of them should have insulated the balance sheet by now.
Ben, I guess the question is for the Fed, look, many of our guests foresaw that there would be pressures across the financial system. Of course, as rates rise, that there would be cracks. We're seeing those cracks now front and center. Can they really get to, as the market expects, 5.6, 5.7%? When you start to see these cracks expanding like this, what are the implications for the Fed? Do they take a pause? Do they take a breath on the back of what's happening across these markets now?
The Fed will doubtless be concerned about what's going on with the SVB. No one wants a systemic crisis blowing up in their face at a time like this. And the Fed has been acutely concerned about it. But they've done adequacy tests. Banks' risk adequacy capitals have been vastly improved since the financial crisis. So it's not a systemic crisis at this point, but certainly the Fed would stop and pause here and think, hang on, is there a wider systemic risk that we need to take into account? At this point, it doesn't look like, and we are going to get the non-farm payrolls data and the inflation data next week. And together, the Fed will be reading those tea leaves and saying, okay, what's the best course of action here? Perhaps not 50 basis points, as the markets were thinking earlier this week. Maybe it's at 25 basis points, but certainly the Fed may be inclined to go slow from here.
All right, Ven, thank you so much for all of the insight. Ven Ran there, a Bloomberg MLive editor. Now, coming up, Sunak travels to Paris to meet with Emmanuel Macron, the French president, today. The first such state visit in 5 years. So we're also live in Paris. We'll discuss what's on the agenda next. And this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
Is the OK's getting ready to make a decision?
Welcome back to the Open. We are 24 minutes into European trading day. Look, stocks are down, but if you look at the banks, that's where they're really, really down. I think Deutsche Bank, last time we checked, was down some 6.7%. So let's get that board up so we show you the banks. But really, the main question across the world, and that started in Wall Street yesterday, is could this be the start of a much bigger problem? Now, very simply put, it's the fact that rising interest rates have actually left banks, with a lot of these low interest bonds that cannot be sold in a hurry without losses. What does that mean? Is it an existential question? And let's say probably not. Does it mean that they actually have to offer more to keep the deposits? Maybe, and that, of course, will hurt some of their earnings going forward, Tom.
Yeah, indeed. And you're seeing yields under pressure, of course, money moving into gilts and bonds on the back of what's happening. Later today, of course, in Paris, in terms of geopolitics, UK Prime Minister Rishi Sunak is meeting with his French counterpart. It will be the first summit between the two nations since 2018. And it comes, of course, after the announcement of the Windsor Framework deal on Northern Ireland. But after years of post-Brexit strains, will they be able to patch things up?
Emmanuel Macron and Rishi Sunak have a lot in common beyond their skinny blue suits. After studying at elite schools, they both did stints in banking. Macron spent 4 years with Rothschild, while Sunak began his career at Goldman Sachs. They both moved into politics and helped run their nation's economies. Macron wasn't yet 40 when he was elected in 2017, while Sunak became Prime Minister at 42, the youngest leaders in their country's post-war histories. But, given their well-heeled backgrounds, they've also suffered criticism for being out of touch with the people. Now, at the pinnacle of their political careers, they could help shape the future relationship between the UK and the European Union after years of mishaps. Macron frequently clashed with former Prime Minister Boris Johnson over matters including refugees crossing the Channel and a secret submarine deal between the US and Australia that sidelined France.
I just think it's time for some of our dearest friends around the world to, prenez un grip about all this, and donnez-moi un break.
Macron responded by telling Johnson to get serious. Today, the French president looks ready to turn the page. At a time when the Allies need a united front to support Ukraine against Russia. For his part, Sunak could stand a friend on the continent to put an end to years of Brexit acrimony.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digital Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day. Here are your top stories. Of course, Silicon Valley Bank, our top story, plunging 60% as the startup lender struggles to restore confidence in its financial health. The move drives the biggest slump in U.S. bank shares since 2020. European banks not far behind. So traders dump stock and buy bonds as concern about the U.S. banking sector sparks fears of broader economic distress. European lenders plummet, sending equities on the continent to their lowest in a month. Plus, we get the U.S. payrolls report later on today for February. We'll be watching for clues as to what the Fed does next. Tom.
Okay, let's check in on these markets then, zeroing in, of course, on the banking sector, but broadly across the European index, down 1.6%. Those are the losses pronounced, of course, here in the UK. The FTSE 100 off by 133 points, down 1.7%. Similar picture over in Germany, the DAX, the German lenders feeling the pressure. Certainly the sell-off is pretty convincing across the banking space in Germany, down 1.7% across the broader index. When we look at what is happening then in that sector, the banking sector now down 4.4%. For the context, and we've been talking about these unrealized losses around securities. Globally, banks have about, or at least $600 billion of unrealized losses. They don't have to realize those until, of course, they have to face those liquidity challenges. There's no evidence yet that European banks will have to do that, but clearly there is a question about the contagion risks. We had Silvergate Bank collapsing earlier this week, and then, of course, the surprise capital raise from Silicon Valley Bank. Let's check in on those banks then. The biggest losers, Commerce Bank down 5%, Barclays off by 8 points, down 5.4%, and look at Deutsche Bank go, down more than 7%. Linkages, of course, to the concern around Silicon Valley Bank. Fran.
I mean, I keep on looking at these boards and think, wow, Deutsche Bank down 7.3% on the back of that. Commerzbank down 5.3%. Exactly what's going on? Silicon Valley Bank, who we know is a little-known lender outside the tech circles, sparking this wave of panic that's dragged down banking shares around the world. The turmoil came after SBB, which is a major lender to startups, announced a surprise share sale. Now, the bank's top executive has urged calm, which sometimes is actually not a good idea. For a wider market reaction, let's bring in our very own Danny Berger. So, Danny, the sell-off continuing in Europe quite dramatically. What exactly is spooking the markets? The fact that you're going to sell off some of the bond holdings, you could get it at a loss?
Well, yeah, in terms of what's spooking at SVB, that's it. And I think the concern is, does it go further than them? Do other banks have this liquidity constraint? are there solvency risks? So the actual name of this thing is called held to maturity. If you stick this label, if banks rather stick this label on the bonds in their portfolio, they don't actually have to mark to market. They don't have to mark to market them. They don't have to account every time there's a loss in this bond market. So SVB, for example, at the end of last year said, hey, the bonds we hold that have this held to maturity label, they're worth $91 billion. But the reality isn't really that. And if they have to liquidate them into the market, they're not going to get that amount of money. And Tom, you said this, it's put really perfectly. If you have a bunch of these banks with the same situation that their balance sheets say one figure, but the reality is different, what happens if there's a run on the bank? Could you actually have some insolvency? I mean, at the moment, it's not clear that big banks would have this problem. They probably won't, let's be honest. They have things like swaps, more things to hedge themselves against this kind of risk. But when it comes to the regional banks, maybe not.
And that's key, isn't it? Again, referencing the comments from Goldman Sachs, the likelihood of contagion from smaller banks to larger is remote. Some people might say, well, they would say that. What is the contagion risk at this point then, Danny? You talk about the big if around those liquidity challenges, whether you do have to sell off those securities. Is it likely just to be isolated to the smaller banking sector then?
Well, in terms of a macro picture, there could be really big risks because the Fed, they talk to regional banks all the time. They know the issue at hand. The St. Louis Fed just wrote a blog post only a month ago flagging this specific risk, not SVB, but this idea of this mismatch between the collateral and between client assets. So the Fed knows that this is a problem, and of course, they need financial stability if they want to hike rates. If they don't have financial stability, if they're looking at a risk among small banks, are they going to be able to go 50 basis points? This market has already started to price that out. So even just setting aside the banking sector from a macro perspective, yes, this could absolutely have consequences.
Okay, Bloomberg's Danny Berger on the market context and the risks around contagion. Let's bring in Bloomberg's finance reporter Tom Metcalf then for more on this evolving story. Tom, talk to us about what's going on at SVP and what the read across is to the European banking sector. We've been flagging the fact that stocks have plummeted here. Is this a knee-jerk reaction or are they smelling blood?
Yeah, I mean, I think where it comes to me is fear. I'm watching these share prices fall, and it's amazing. This is Barclays going down 6-7% off, an event that's happening really in Silicon Valley for a pretty sort of focused niche bank. But like Danny was saying, it's the unknown, and really the fundamental problem with SVB right now is this mismatch between very unsticky depositors who can pull their cash out, and obviously they have all these various commitments. So I think the question is in these big complex banks, how much of this situation is kind of replicated, even if on a small scale. But yeah, I think for me, it feels like a very sentiment-driven thing, and I'll be kind of very curious to see how the markets react as the US opens, and particularly obviously SVB, down 60% yesterday. On that sort of individual level, what happens to the stock today will really probably dictate where this story goes.
Yeah, and what I struggle to understand is really it's the smaller mid-sized banks where funding is usually less diversified that would struggle the most. So how do you explain a Deutsche Bank down 8%?
Yeah, no, exactly. Well, I think it's probably just that sort of any uncertainty, investors are going to flee from that, right?
Yeah. So do you have to pay more? I mean, I don't know whether, longer term, it means that they have to pay more for deposits and that, people are starting, I don't know whether it's just fear in the markets or whether they say, look, longer term, they're going to have to cut into their revenue by offering more to make sure that these deposits stay in the banks.
Yeah, no, that's what a few people are telling us, exactly that, right? You're going to want to encourage those sort of, show that stability, encourage depositors in to stick with it. So it's sort of a bad picture, just in very general terms. But yeah, it would surprise me if you're going to see the similar sort of problem we've seen at SVB at some of the very, very big lenders, even though we're seeing these big share price fluctuations.
2022, this was the beloved sector. Of many a fund manager. What a turnaround. How did investors not see this coming in terms of the pressure when it comes to depositors?
Yeah, no, it's interesting. I think, it's just that directional movement, right? And that is what has kind of been dinging banks like Lloyd's as well. Folk have been looking so closely at their net interest margins and kind of just extrapolating out increases. What it looks like now, particularly from Q4 results, is that net interest margin certainly isn't going to be growing any further, certainly not the pace it did in 2022. And when you kind of lose that growth, then obviously the sort of share price increases start to backtrack.
Yeah, and again, I guess it's once there's fear in the market, it's very, very difficult to get ahead of that. And this is not only SVB Financial, right? It's also Silvergate's abrupt shutdown. This is more linked to crypto, though.
Yeah, exactly. Kind of for me, there's two pretty different things, even though they're both California banks. But I think what it's showing is, look, you've got multiple banks kind of in trouble. That is not going to be reassuring to shareholders. And I'm just sort of readying myself for a pretty turbulent day in the markets, I suspect.
Tom, just briefly, how reassured should we be or not about the oversight that regulators have of the banking sector?
Well, that's what we're asking around. Like, what are the regulators doing, in the UK, in the US, in terms of this situation? Are they, for example, asking questions to the bigger banks like, hey, is this a concern for you? Or, like we've just been saying, is it more of a sort of an isolated case? You've kind of got to ride through the volatility and hopefully come out the other side.
So is there anything, do you think it'll be, I know this is like the impossible question to ask, but there could also be, some people buying into this dip if there's nothing too ugly.
Yeah, exactly. No, I love an impossible question from the scene. But yeah, no, you've had a few,
I know this is the only reason why you come on TV, so I don't want to disappoint.
No, I'll wildly speculate. But no, yesterday, and part of what's driving this, right, is the VCs. Some VCs are out there going, hey, we need to pull cash out. Yeah. There have been a few going, wait. A, show some loyalty to a bank that's been around for 40 years and helping this sector. And B, I think this is a buying opportunity. So you've had a few kind of coming out and saying, we're actually going to be buying the shares.
Okay, Tom Metcalf from our finance team, who's going to have a very, very busy day ahead for him and the team. Thank you very much indeed. We're just checking on the bonds, Fran, of course. There's been a big move into European debt, UK debt as well. Yields coming off significantly at the front end, the 2-year gilt down 14 basis points on yields. Across the US Treasury curve as well, yields coming in. And on bunds at the front end, 3.11 on the 2-year. That's a move lower by 16 basis points, Fran.
Yeah, ironically, if you look at the bank stocks, of course, a lot of the equity investors had piled into financial stocks to ride out the Federal Reserve's interest rate hikes. So this is also kind of like a double whammy. I know we're looking at U.S. Treasury yields, but intuitively, when Treasuries move, a lot of investors will say, look, let me buy into financial stocks, especially in the U.S., which is why maybe we're also seeing a huge pullback when it comes to banking stocks, because they're betting that it would pave the way for lenders to earn more. So it's a kind of double-edged sword, which could also explain at the margin why Soc Gen is down 5.4%. Deutsche Bank, they must be seeing something that we're not seeing yet. Maybe they have more exposure to some of the bonds. Maybe they're waiting for some kind of big shedding of that. But it's an ugly day, certainly, if you're an investor in a lot of these banks.
And, well, to your point, the focus on net interest margins in 2022 as global rates increased means that there could be a significant investor base that's going to get burnt here. You're seeing a drop now across the sector of 4.4%.
Coming up, we speak to the mayor of Rome and former Italian finance minister, Roberto Gualtieri. That exclusive interview is up next, and this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? Mm-hmm. So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah.
And so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Week, Balance of Power is on the move. Starting Monday, March 13th, Balance of Power debuts at 5 p.m. Eastern Time, live from Bloomberg's Washington headquarters. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis at the intersection of politics and business. Balance of Power, weekdays at 5 p.m. Eastern, starting Monday. Only on Bloomberg, your global business authority.
this could be a tame example. There are many other banks out there, so it's very rational for investors to be asking, is there contagion in train right now?
I really don't believe that that's likely.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
If they can raise the capital, you know, it's not an existential issue.
Yeah.
Right, top business leaders weighing in on the panic spreading across the startup world after Silicon Valley Bank plunged 60% as the lender struggles to restore confidence in its financial health. Welcome back to the Open. We are 44 minutes into the European trading day. You're seeing losses across European stocks of 1.6%, futures lower in the US, and of course the banking sector under pressure here in Europe. That sector currently down 4.2%. Losses of around $47 billion US in market cap across US banking by the end of the close yesterday. Fran.
So we're talking, of course, about the bank after banks in general. We're seeing a lot of pressure on some of the European banks. I think Deutsche Bank was down 7.5%. Silvergate's abrupt shutdown and SVB's hasty fundraising have sent US bank stocks diving. European banks also following. Across the investing world, people are really asking, who's the next one? Now, to help us unpack this, but also talk about Italy as an investment destination, we look at the banks are actually not seeing a huge fallout, but I'm very pleased to be joined by the mayor of Rome and former Italian finance minister, Roberto Gualtieri. Mr. Gualtieri, thank you so much for joining us. For many years, I followed you actually around the world trying to ask you about the stability of the financial system when you were finance minister of Italy. I remember chasing you at G7s, and you always were very thoughtful in your answer. So today, we see banks under extreme pressure. I think Deutsche Bank is down some 7.8% because people are asking, what's happening? Who's next? Are we valuing some of the bonds correctly? Do you worry about the stability of the financial system in Europe?
No, I don't, honestly, because, of course, situation is new for a number of elements, but the fundamentals of the economy and the financial sector are robust and solid. So I see some temporary problems like today, but I don't see, honestly, banks are well capitalized, and so honestly, I'm more optimist.
Are you concerned, though, sir, about defaults picking up and the pressure that could put on the banking sector?
I'm sorry, could you repeat the question?
I just wondered about your concern about the level of defaults and whether they're going to accelerate in this environment of higher interest rates.
There would be some, that's clear, but as I said, I don't see this as an element that can destabilize the financial system and the banking sector. So as I see the numbers and the fundamentals of banking sector, and they are robust.
Mayor, when you look at, I mean, as mayor, you also need to go through refinancing. You also have businesses that are based, of course, in your host country, but also in your host city, Rome. Is there a worry that interest rates have gone so high so quickly that we're not seeing some of the underlying consequences? And what does that mean for how you manage Rome?
No, I mean, clearly now I see and I hope that the ECB will look carefully of the path and the projection that would not warrant for further tightenings, but at the same time, as I see the consequences of this tightening so far have not been so negative as some would have thought and expected. So our financing conditions are good, and we have to put all this in the context of a major and unprecedented investment plans that are going on right now. So we see, of course, price increases. We see the consequence of this new financial condition, but we don't see major things that could derail, let's say, the economy or prevent us from going on with our investment projects.
Is the regulatory framework sufficient? What would you say to regulators at this point in time? What should they be looking at specifically?
Are you talking about financial sector or more in general state aid rules? And because this is also this element. What is clear is that now we are having a major relaxing on state aid rules in order to allow Europe to compete with the US in terms of investment for energy, for defense, and for our supply chains, and which is good, of course. And we also understand that so far, as we are going on with a major investment program, we first have to demonstrate that we are able to spend well the current EU money before having new borrowing and new additional investment. But if you look let's say more in the medium term, the investment needs for energy, for climate change, for innovation, for also coping with, let's say, the demographic changes of population, we clearly very well know that we need to continue with additional EU borrowing capacity and common spending. So that's a major element, and so we have to see whether the time which is needed politically to agree for this new phase would be enough, or we need to do something more quicker.
Mayor, Rome, of course, is trying to host the International Expo in 2030. Rome has lost out to maybe the other capitals in Europe, but also to Milan in terms of a destination for business and investment. What is your three-year plan to get that back on track and maybe even win Expo?
Expo is a major opportunity, and also we have, I would say, a very great project that would also structurally change a part of the city and build a post-Expo in the sense of sustainability, innovation. But I want also to underline that currently we are undertaking the greatest investment program of the last decades in Rome to modernize the city, to make it not only an efficient city respect of ordinary services that were a bit lagging behind in the last years, but also becoming on the forefront of the new challenges of digitalization, of technological innovation and transfer to the economy, of sustainability. And we see already the signs of a great attention of investor toward this new, let's say, more vibrant environment in Rome. We have a lot of PPP, project finance. We have a lot of interest about our idea also of urban regeneration. So we are extremely confident.
Okay, Mayor of Rome and former Italian Finance Minister Roberto Galtieri, thank you very much for your time. We do appreciate it. Okay, coming up, European banks taking a hit this morning from the Silicon Valley Bank trouble in the US, of course. Could it impact the ECB's upcoming policy decisions? We discuss that next. This is Bloomberg.
Somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
This could be a tame example. There are many other banks out there. So it's very rational for investors to be asking, is there contagion in train right now?
I really don't believe that that's likely.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
If they can raise the capital, it's not an existential issue.
Top business leaders weighing in on the panic spreading across the startup world after Silicon Valley Bank plunging 60% as the lender struggles to restore confidence in its financial health. I would suggest it's probably not stressed amongst startups. It's probably stressed amongst European banks. Certainly, if we look at Société Générale, down some 5.3%. Deutsche Bank also under pressure. Look, rising interest rates has definitely left some banks, with these low interest bonds that cannot be sold without a loss. So the question is, who else is exposed? How much are they exposed? And will they be fine if there's no bank run? I find it hard to imagine that someone like Deutsche Bank has as much exposure, or a non-diversity profile bank like SVB. So it's unclear why there's so much panic to me in the market.
Yeah, we're still trying to get a sense as to whether or not this is a knee-jerk reaction, a knee-jerk sell-off to the panic and the concerns around SVB, or something more problematic, more systemic when it comes to investor concerns about the banking space. Again, we are hearing from many that the regulations around the bigger banks are secure and the oversight is focused, of course, on these balance sheet problems. But yes, more broadly, the banking industry is sitting, as you say, on about $600 billion worth of unrealized losses at this point. The banking sector currently down more than 4%. You mentioned Deutsche Bank. That bank down 7.2%. Let's check in on bonds as well, because the money has been moving pretty aggressively into the debt markets of Europe and the US. Yields coming off across the curve in the US. You're looking at 2 years now, below 5% at 4.8. So that's a more than 30 basis point move in the last 24 hours, 6 basis points today. Across gilts as well, yields coming down 11 basis points at the front end. German bunds at the front end, 314. That's a 14 basis point move lower in German bunds.
That's it for the European Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. European banks slammed after Silicon Valley Bank plunges 60% as the startup lender struggles to restore confidence in its financial health. We'll bring you the pre-market latest in just a moment. Traders dump stocks and buy bonds over concern of broader economic distress. As U.S. bank shares slumped to their lowest since 2020. We speak with the founder and chief executive of Algebris, Davide Serra. Plus, we get the payrolls report later today for February. We'll be watching for direction of the Fed's rate hiking path. Now, first thing is first. It's a big day for the markets. If you look across the board, a lot of these banks are getting slammed. By far, the biggest industry group, losing the most, 4.4% lower. Now, the German 10-year yield, I know there's generally a risk-off mood, but the question is, and we will spend probably the next hour to really try and deep dive into this, is what exactly is happening with the banks? So do we worry about a contagion risk? The big question, of course, that started yesterday is not only what happens with SVB, but Wall Street and analysts are pondering a crisis. This, of course, is because rising interest rates have left banks laden with low-interest bonds that cannot be sold in a hurry without losses. Who would have to sell some of these if there was a run of the banks? And does it mean longer term that the business model of some of these banks will be put under pressure simply because they'll have to hire or they'll have to offer more to make sure that some of their clients stick to them to some of the deposits? Now, some of the questions that we have is, first of all, why Deutsche Bank is down 7.6%? Is this a modeling problem going forward? And then if you look also at the investors and what they've done over the last 5 to 6 months was actually pile into some of these stocks simply because the Fed is also rising interest rates. So the easiest way to get protection with rising interest rates is actually going to some of the banks. But of course, there's a vicious circle if then there are questions about whether they need to sell some of these bonds at a loss. Santander down 4.5%, and you can see Intesa Sanpaolo over in Italy 3.2% lower. I think we also have pre-market, some of the U.S. banks. This is critical, as our Tom Metcalf, who oversees our financial coverage, was telling us. It'll be interesting to see, first of all, about how SVB Financial is opening. Yesterday, they were down 60% pre-market. They're down 22%. But as soon as some of the American Wall Street banks stabilize, it could also give us a floor for some of the banking stocks in Europe. So Silicon Valley Bank, this lender that is little known, frankly, outside tech circles, has sparked this wave of panic. And that, of course, has dragged down banking shares around the world. It comes after SVB announced a surprise $2.25 billion share sale. Meanwhile, the bank's top executive has urged calm. Well, earlier we spoke to prominent investor Mark Suster, who warned against overreaction.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies. All throughout the global financial crisis, depositors were made whole.
Let's bring in Bloomberg's Danny Berger, who explains this beautifully and in simple terms. So, Danny, what do we know exactly went on at SVB?
Well, it's this toxic mix between a weird accounting quirk, the Fed hiking rates, and trouble in VC land. So the weird accounting quirk thing is that banks are able to hold bonds on their balance sheet and not mark to market them. In other words, when bonds fall, they don't have to show that on their balance sheet if they call them held to maturity. SVB said they had about $91 billion worth of these bonds. And look, if they're taking a loss, they're not putting it on their balance sheet, it doesn't really matter in normal times. When it matters is if you have to liquidate them for some reason and you take a big hit. Now, why might you need to liquidate them? Because there's troubles in VC land. VC companies need money back. You have withdrawals. And that's the fear at SVB and the thought behind why they had put out that release saying they needed a capital injection, that maybe there was this mismatch. So it really is all about that bond portfolio and having to sell it down.
So, Danny, explain to me, like, could this be the start of a much bigger problem? And actually, when do we find out if it is giving some of these European banks are really getting slammed? Again, I'm looking at Crédit Agricole, 3.7% lower, HSBC, 5.5% lower.
Well, look, there are a lot of idiosyncratic things about SVB. For one, its clientele isn't going to look like UniCredit's clientele, for example. It's a lot of VC founders, VC companies, people with a lot of money. It's not sort of everyday people depositing money at SVB. So that's one aspect. There's no diversification within their client base. The other thing is we need to know what the bonds are on the balance sheet. SVB had really long duration type assets that were especially hit hard. Now, what European balance sheets look like, I mean, there's so much regulation. It's not the same type of thing that's going to be hurt as badly if there are liquidations. There are also swaps that a lot of these banks use, so there's more protection there. But when it comes to the U.S. regional banks, perhaps there are more similarities, maybe not so many that the exact same thing would happen. But that's why you saw a lot of those regional banks get hit especially hard.
Yeah, Danny, thank you so much for the great explainer. Danny Berger there with the very latest on SVB. Now, for more, let's also bring in Ven Ram from our Bloomberg MLive team. Ven, I know you're a big thinker on some of these, things that we cover. So the drag from SVB into Europe is quite serious this morning. How is the bank so little known outside of the tech hub in the U.S. causing so much shockwaves this morning?
Morning, Francine. At the moment, what we are seeing in Europe is blind panic as opposed to informed panic. Blind panic because traders are first selling anything that is associated with risk first and then asking questions later. So it's not an informed judgment. Okay, there is going to be another systemic crisis, another crisis that is going to impinge across the Atlantic, cross over the Atlantic and impinge local banks here. That's not the concern. But the thing is, this is about investor psychology rather than fundamentals. And when psychology takes over the markets, you see what we are seeing now, i.e. stocks being sold down and government bonds being bid up.
But we know that rising interest rates would hit some of the bonds. So is it only a problem if there's a potential run on the bank? Van, can you talk to us about, I really don't understand why Deutsche Bank is down 8.5% unless investors piled in too much, or whether they're worried about how much, whether they have to mark this down.
I think, as I was saying, the traders are first selling down all risk assets and then asking questions later. They don't want to be caught holding they are fearful of what if the next shoe drops. And I don't think there is any evidence that this is going to morph into a systemic crisis just yet. But it's panic psychology in the markets at the moment, and therefore investors want to be safe rather than sorry, and that is why they're seeing what we are seeing at the moment.
All right, Ven, thank you so much. Ven Ram there from our Bloomberg MLive team. So we'll have plenty more, of course, from this fallout, what it means for banks and what it means for Wall Street. Coming up later in the program, Algebris Investments founder and Chief Executive Officer David de Serra joins us live. We'll get his thoughts on the banking system. Of course, we'll talk about the fallout from the Silicon Valley bank panic and potential risks to the wider banking sector. That interview, don't miss it, 9:30 a.m. UK time, 4:30 a.m. in New York, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
This could be a tame example. There are many other banks out there. So it's very rational for investors to be asking, is there contagion in train right now?
I really don't believe that that's likely.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
If they can raise the capital, you know, it's not an existential issue.
Top business leaders weighing in on the panic spreading across the startup world after Silicon Valley Bank plunged 60% as the lender struggles to restore confidence in its financial health. Now, markets still absorbing the impact of SVB's financial problems, with European banks selling off this morning. Now, venture capital firms are at the center, of course, of the fallout after Peter Thiel's Founders Fund advised its companies to pull money from SVB. Now, Bloomberg has also learned that a warning from venture investment firm Green Oaks led to its companies withdrawing $1 billion from its bank in recent months. So let's look at, of course, what this means for venture capitalists and, in general, capital access for some of the startups. So we're joined by Eileen Burbidge, a founder at Passion Capital Investments. Eileen, always great to have you on the program. So thank you so much for coming in. First of all, this was a bit of a shock to a lot of people. Do you have any exposure through some of the companies that you're invested in?
We do. You know, you might have seen the stats, and I heard the sort of run through of a lot of analysis you've had in the last 24 hours, which is great and super comprehensive. clearly, I think, some people are attesting to the fact that about 50% of American startups had their money with Silicon Valley Bank, and they were clearly making a large push across Europe as well. They've been operating in the UK for more than 10 years. They recently expanded in the Nordics as recently as just 3 months ago, and so making a really good push. And so there is a lot of exposure across the startup and the venture ecosystem here in Europe.
So, Eileen, what does that mean? First of all, can you give us a sense of what kind of companies are exposed, and what do you tell them right now? Do they keep their money with SVB? It's also, I imagine, very difficult if you're a smaller startup. You may not have a second bank account, so it's difficult to get your money out and put it elsewhere.
Yeah, there's been a range of reactions, and it's really interesting to see, because obviously at Passion we have more than about 50 active portfolio companies. We also do banking as well for the fund and for our fund manager, and then we've also seen what co-investors and others are telling their portfolios, as well as how founders are reacting. And there's clearly one sort of set of reaction, which is let's move our money. And just to be clear, the reason for that thought process is why wouldn't you? Or looking at a cost-benefit analysis, why would you not look to de-risk exposure? And so it just seems like very little action or investment or resource would be required to simply, diversify yourself away from this. On the other hand, there's probably just as many people saying, listen, this is overblown. The bank still has, more than $200 billion worth in assets. What happened and what triggered, its need to raise capital was, bond performance that is pretty separate from what's happening on the deposit side, as well as in terms of its AUM. And so this should all blow over. But you're getting both.
Yeah, is it too soon to make a call on that? And again, we don't want to fill anyone with panic. So I guess cool heads need to prevail in this kind of environment. How many calls have you fielded since this happened from founders that actually aren't really sure what to do?
So we have fielded calls from founders, that's true. We have also fielded queries from our limited partners or our investors in our funds to ask us about our opinion. And the earliest of that came in the beginning of this week. So I think it's the right thing, and I'm quite reassured, if I'm honest with you, that founders are asking for advice and sort of wanting to stick their heads up and see what others are doing. We have the same sentiment as you did, or as you just expressed, which is cooler heads will prevail. Think about the long-term viability and sort of indicators of this on the sector overall, on the bank. For companies that have a large number of deposits at banks, clearly there should have always been a treasury strategy in place. This is maybe a good wake-up call to put one in place if that wasn't already the case. But in terms of, early-stage startups or people with what I think Silicon Valley Bank would term as immaterial sort of deposit sizes or deposit books, we don't think this is existential, to borrow a term from somebody that you ran through in the run-through in your recap, just opening up this segment.
Yeah, and Eileen, I have to say, it's quite incredible to look some of the banks in Europe also being slammed. Deutsche Bank down 7.8%. Mohamed El-Erian, who I always follow very closely, says, look, there's a lot of chatter about a generalized U.S. banking system stressed due to some of the troubles. And he says, look, although the system as a whole is solid, it does not mean that every bank is. Does this have repercussions? We don't know how this will end, Eileen, but does this have repercussions to how startups will access capital?
So I think that it will. I think startups will consider the fact that, maybe having all of its funds, depending on how much it raised, let's be clear, sort of an early stage startup, which might have raised $1 million, $2 million, $3 million. I don't think it's going to be existential for them or necessarily something they should invest a huge amount of time in. But certainly for your growth startups, who have raised tens, if not hundreds of millions of dollars or pounds, who might also have debt facilities, for example, through SVB or other banks, there should be a treasury function in place. They should be thinking about diversifying and in order to hedge against risk of any single exposure or point of failure. And so it is a good reminder of just general, I think, prudent fiscal and treasury policy. I think that as we've seen overnight, a lot of the U.S. banking sector actually took a lot of losses. As you've just alluded to, it's happening in Europe now. Again, just as it's a reminder to startup founders and startup investors to go back to fundamentals and prudent policy, it's the same in terms of, I think, the sector looking at all of the other banks that have probably had a pretty good run for the last few years unchecked. in order to say, okay, let's just look, under the covers here.
Eileen, thank you so much. Smart and measured, as always. Eileen Burbidge, founder at Passion Capital Investments. Now, coming up, the Prime Minister, Rishi Sunak, travels to France to meet with the French President, Emmanuel Macron, today, the first such state visit in 5 years. So we're live in the French capital. We'll discuss what's on the agenda next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Chinese lawmakers have voted unanimously to give Xi Jinping a third term as president. Xi won the vote in the National People's Congress by 2,952 to 0 against, giving him 5 more years in power and demonstrating his unrivaled grip over the ruling Communist Party. Li Qiang is expected to be named premier in tomorrow's session. Now, police say 8 people have been killed in a shooting at a Jehovah's Witness church in Hamburg. During the night, police in Germany's second biggest city say they believe that there was only one shooter, but it's unclear if they are among the dead. The US and India are to sign an agreement to boost coordination on chips and are discussing how to avoid over-subsidization. Commerce Secretary Gina Raimondo has traveled to the country as she looks to boost incentive plans for chip producers. Both countries are pouring government money into subsidies for the industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Thank you so much, Leanne. Now, UK Prime Minister Rishi Sunak meets with his French counterpart, Emmanuel Macron, in Paris today. After years of post-Brexit strains, all eyes will be on whether the two leaders can patch up this relationship. Well, our UK correspondent, Lizzie Burden, joins us now from Paris. So, Lizzie, what does this summit actually mean symbolically?
Well, Francine, bromance is in the air here in Paris. Rishi Sunak's on his way here to the Elysee for a bilateral meeting with the French President Emmanuel Macron at 10 a.m. UK time. This is after, as you say, years of acrimony between the two countries. But already it looks like there's better chemistry between the two, even more so, well, much better so than with Boris Johnson or Liz Truss. The two, Sunak and Macron, are both ex-bankers, of course. They're both fans of skinny blue suits. And the foundations have been laid with the Windsor Framework, the New Deal on Northern Ireland. They're expected to then meet with business leaders from both countries, and then we'll have a joint press conference at 2 p.m. And it's ahead, of course, later this month, a visit from King Charles, a state visit. So really, this is being presented as a watershed moment in Franco-British relations. On the substance, they're going to talk about defence. Of course, they need to present a united front on Ukraine, especially when Russia will be watching. They need to heal some of the wounds left by the AUKUS deal, the US, UK, Australia deal on defence, which essentially sidelined the Franco-Australian submarine deal that had been on the table. But Sunak's also going to want to come home with a win on small boats, the flow of migrants crossing the channel. It's a thorny issue to unpick, a difficult one to solve. Neither side is going to want it to overshadow the rest of the talks. And it's controversial because this week the UK government introduced legislation to deport almost all asylum seekers who reach Britain, regardless of their asylum status. The timing before this visit, as I say, interesting, but Eurasia Group's Mujtaba Rahman observes that perhaps it was less about putting pressure on Macron and more about distracting from how little realistically Sunak's going to be able to bring home on that issue.
Yeah, although I guess the tone is shifting, and of course that probably means something also on the clearinghouses on financial services. Thank you so much, Lizzie Burden, there, Bloomberg's UK correspondent for us at the Elysee Palace in Paris. Now, of course, we'll be covering all things UK every week on Thursdays, 9:30 in our half-an-hour special. The main story, of course, today is what's happening with SVB Financial, but also the fact that there was another abrupt shutdown at Silvergate. Now, the issue at both of these Californian lenders was an unusual fickle base of depositors. So keep that in mind. But actually, the big question is rising interest rates have left banks with these low-interest bonds that cannot be sold in a hurry without losses. So what does that mean if there's a bank deposit, a run on banks, and this is a vicious circle, pre-open, pre-market, SVB Financial, a further 22% lower, and it's really infecting a lot of these European banks. Deutsche Bank down 7.5%, HSBC here in the UK down 5.5%. Coming up, a roundup of our main banking news with Davide Serra of Algebris. This is Bloomberg.
out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah.
So what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
European banks slammed after Silicon Valley Bank plunges 60% as the startup lender struggles to restore confidence in its financial health. We'll bring you the U.S. pre-market latest in just a moment. Traders dump stock and buy bonds over concerns of broader economic distress as U.S. bank shares slump to their lowest since 2020. We'll discuss that with the founder and chief executive officer of Algebris Investments, Davide Serra. Plus, we get the payrolls report later today for February. We'll be watching for direction of the Fed's rate hiking path. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Returning to the top story this morning, by far, a U.S. bank known for lending to startups has sparked panic across the sector. Now, worries over the financial health of Silicon Valley Bank prompted some venture capitalists to advise portfolio businesses to withdraw their money, even as the bank's top executive urged calm. Well, let's get straight to Algebris Investments founder and chief executive officer Davide Serra, who understands the banks intimately. Rising interest rates have left some of these banks, Davide, of course, with some of the low interest bonds that they cannot be sold in a hurry without losses. We're seeing a lot of the European banks slam. Deutsche Bank down more than 7%. The same for HSBC, down 5%. Is this justified?
Listen, this is just pure panic, because what has happened in these two small California Silicon-based Valley firm, one was intimately linked to the crypto world. We know what a huge fraud FTX has been, and that's basically the Silvergate demise. In the case of Silicon Valley Bank, first of all, the name says it all. It's a Silicon Valley Bank. This bank tripled its deposit in 1 year. Now, this doesn't happen to anyone in the world. And basically, they got deposits out of VC, and then this bank was lending money. So it was part of a VC bubble in Silicon Valley. Then what happened? They had to buy treasury, so they didn't make a mistake. They bought very safe assets. But the sharp rise in interest rate forced them to realize some mark-to-market losses, because eventually the same VC that deposited the money panicked. So I think it's a one-off, intimately linked to the Silicon Valley and tech bubble, and reminds everyone that you need to keep your deposit. Yep.
Diversified, right? And this is a point, is that if you're a small and mid-sized bank, then maybe your funding is less diversified than the others. But talk to me about the big banks. So I don't believe that analysts are getting it wrong or shareholders are getting it wrong and selling off some of these big holdings just because they don't understand the story. Is there a longer-term concern that the revenue will have to change because actually they'll have to compete higher or harder to, for example, by offering some of the higher interest payments to savers to keep them there?
Actually, the opposite. So I think today it's a reminder that you should keep your deposits only in heavily safe, deposited, and well-regulated large institutions. When people chase returns or services in small financial institutions, they always run a huge risk. The Financial Stability Board has created a list of globally systemically important financial institutions, which is the one we focus on. So the HSBC, the Deutsche Bank, the BNP, the UBS, the Intesa, the Santander. These institutions have more capital, more regulation. There is a reason then, as a depositor, you are safer. Clearly, they're not going to pay on your deposits, the hot money of some startup and VC firm will, but then you can sleep at night. And so what I think is going to happen is every institution around the world is going to look at it, where am I keeping my deposits? And they're going to move them to the JP Morgan, Morgan Stanley, Bank of America of this world. And hence, if you've been, let's say, riding the crypto and tech bubble in VC and hot money, you're probably in trouble. Many fintechs will end up in trouble. I've always said it. Fintech are great for TVs. I wouldn't keep my cash there. And many institutions are going to do the same.
Yeah, David, just a reminder, for the moment, it's alleged fraud with FTX. Otherwise, I'm going to get a call for the lawyers. But ironically, right, a lot of equity investors piled onto some of these big banks, Wall Street banks or some of these big European banks, because financial stocks are a good way also to ride out the Federal Reserve's interest rate hikes. Will that take a pause or a breather?
I think, certainly, let's say, the interest rates have gone up faster than ever in history. And hence, in a way, market expectations are that this is going to come up in huge profits short term. The sharp rise in interest rates has second-round effect, and we're seeing some now in California. In Europe, I think the opposite is going to happen. So it's going to be a slow increase in net interest income revenue, and the safe and strong deposit institutions are going to make more profit vis-a-vis the smaller one. And the reason, because at the end of the day, financial institution, it's all about trust and the level of a capital that protects depositors. And hence, in a way, I think we're going to see a concentration of profit in the stronger and large institution. There is one good news here. This time, the Silicon Valley Bank didn't have fake assets. It had U.S. Treasury, let's say the highest quality asset on the planet. And hence, there's nothing wrong on the asset side of financials, remember. And this is, to me, is the reason why today it's a good investment opportunity for long-term holders. And the reason is because European financials are now yielding 8 to 10% between dividend and share buyback, and they have 10 times the level of capital and less risk than they used to have, and hence they provide a good, safe, long-term investments.
So, David, does it mean that you're buying some of the stocks of the bigger banks today? And again, someone who I, immensely respect and follow is Mohamed El-Erian, and he wrote a couple of tweets this morning saying, look, while the U.S. system as a whole is solid, it does not mean that every bank is. So would you also have concerns, and we have to remain measured, but do you also have concern for some of the smaller banks maybe that are less diversified, and when do we find out about those?
Yeah, so let's say there's one difference. In the U.S., some of the smaller regionals can account basically part of their bond portfolio in a different way than the large U.S. financial institutions do. So first of all, large U.S. financial institution, zero risk. Secondly, they're going to get the business out of a smaller one, hence even more positive. In Europe, none of that applies, and hence in Europe, that phenomenon never happened for a simple reason. We never had a tech bubble in Europe. Secondly, no banks grew up deposits by 3 times in 1 year. And third, no one just landed to start up basically getting deposits for VC. So that's a pure one-off phenomenon in California, does not apply to the rest of the banking system, which in effect is as safe as it's ever been. But it's not, you need to trust me, you need to trust the Fed and the central bank, the ECB, that run stress tests on all the major financial institutions. The smaller one might have some troubles.
And again, a lot of people are saying, and this is in no way any vindication of the ones that said, look, it's just almost impossible to go from interest rates at 0.5 or 1% to 4.5%, 5% without something breaking in the system. If it's not this, is there something else that you worry about? Or overall, do you think the financial system is strong enough to withstand even more interest rate hikes?
So the core of the financial system again, the top 70 largest financial institutions in the world are super safe. And if anything, out of this turmoil, we're going to get even more deposits and becoming even safer. Then clearly, the excesses of high leverage, bubble valuation, whether it's VC, crypto tech, part of the real estate sector, are going to end up in trouble. This is the reason why I think the sharp rise in interest rates now deserve a pause, because we have too many uncertainty in the world, and the second round effect, it takes time. And hence, I think in the end that we're going to see central banks realizing that the second round effect are coming through, and hence it's time to pause, because you might run a risk, if anything, of breaking the weak part of the system and then not understanding, again, the round effects.
Thank you so much, Davide, as always, for, of course, your thoughtful messaging on the bank's Algebris founder and chief executive officer, Davide Serra. Now, earlier this week, we also spoke to economist Mariana Mazzucato about her new book, The Big Con. The book takes aim at the consulting industry and its role in business and government. Today, it's the consulting industry's turn to respond. Well, we're now joined by Tamsin Isaacson, the chief executive of the Management Consultancies Association. Tamsin, thank you so much for joining us. I'm sure, like me, you've read the book. I'm sure, like me, you've looked at exactly, what the way in which the government relationship with maybe some of the big four or some of the big consultancies will change on the back of that. What's your response?
Well, I think it's full of inaccuracies and disinformation, to be honest. Our industry is focused on delivering brilliant results for our clients. We work with tens of thousands of clients across the private and public sector very successfully. And the reason why we're experiencing 25% growth, the reason why we're employing 10,000 more people over the next couple of years is because of that delivery. We transform businesses, we transform government departments, we bring in specialist expertise and world-class capabilities, and it's really about short-term projects. It's not about displacing government resources, it's about short-term projects and providing real value for our clients.
I mean, is there something that would make the industry better, given the criticism that they've received also on not only revenue, but actually how they treat some of their employees?
I think as an industry, we are always striving to set the very highest standards for ourselves. So we invest hundreds of millions of pounds in terms of training and developing our staff. The members I represent are some of the best companies for apprentices, for diversity and inclusion. They are leaders in the private sector for the way they treat and the way they employ and recruit staff. So I reject that claim totally. We as professional services firms lead not only...
You can always become better. I mean, you can't say you're like, you're a leader in industry, and there have also been taking issues with some of the things that, others have claimed about the industry. But you can always improve from what you have right now. Where would you improve the industry?
So setting standards is really important, and helping clients to be better buyers of consulting is what we help them with. And that's exactly why we supported government with the Consultancy Playbook, which is a brilliant set of guidelines for government buyers about how to reach to the entire market, how to make sure that you're clear on the outcomes that you want to achieve before you contract consultants, that you have a clear governance process during that project, and fundamentally, at the end of a contract, you are transferring skills to the government department. You are upskilling civil servants, and you are leaving them in a better place. And that's what our members, MCA members, deliver.
Tamsin, thank you so much for joining us. Tamsin Isaacson, their Management Consultancies Association Chief Executive Officer, responding to some of the claims in this explosive new book. Now, coming up, we're joined by the former EU Chief Brexit negotiator, Michel Barnier. We'll get his thoughts on today's UK-France summit today in Paris. That exclusive interview is next, and this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it. The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now, later today, the UK Prime Minister Rishi Sunak meets with the French President Emmanuel Macron in Paris. It will be the first summit between the two nations since 2008, and it comes after the announcement of the Windsor Framework Deal on Northern Ireland trade. Well, we are delighted now to be joined by Michel Barnier, the former EU chief Brexit negotiator, for an exclusive conversation on this. Mr. Barnier, thank you for joining us. Talk to us a little bit about what the relationship looks like now between France and the UK. It certainly looks less difficult than when you were in charge.
Good morning, Francine, from Helsinki. This summit between France and UK is a good news. After 6 years of cold mistrust or even disappointment, remember the problem we face with the submarines crisis about Australia, and where we saw the UK, not only the UK, but also the United States acting not as allies must do normally between allies. So we are going to turn this page, and I think it's a good news. And I think it's a good news because we have so many challenges to face together. Global challenge that we have to look ahead more than looking at the past with nostalgia.
But so, Monsieur Barnier, when you look at, of course, some of the discussions that they will focus on between Prime Minister Sunak and President Macron, this will be, of course, on energy, on security, on migrants, and on Ukraine. What do you think can really be achieved?
I'm not involved in the details of this negotiation, the preparation of this summit, but I can expect that on Ukraine we will find a way to consolidate together the support to the Ukrainian people, even by sending arms. On migration, we have a very strong and very serious issue with so many deaths all along the channel. We have to tackle this issue with being firm and rigorous, but also with humanity, respecting the international law. And I think that the UK has to be careful not to be too far from the European policy. We have to tackle some other issue on economy. Perhaps, if I may, to reflect together what could be the common answer of the UK and France, UK and Europe to the new protectionism of the US, which is very serious. It put at stake many strong part of our industry or agriculture. So, if I may say, there is also 2 chapters where Boris Johnson refused to engage any kind of negotiation during the Brexit negotiation about cooperation with Africa, which is a common challenge for all of us, and also defense and security. So these two chapters are now for the future open, and I think it would be a good idea for France and the UK together to push in that direction.
Monsieur Barnier, when you look at the finance and actually the fact that a lot of Wall Street banks had to choose almost a European capital outside London, it does seem that a lot of investment and a lot of bankers have moved to Paris. Is there anything else that France can do to roll out the red carpet?
The government of France is always acting to stress and to support and to consolidate its attractiveness. But to be frank, it's a choice of the UK to leave the EU, not our choice. London was, and in a certain sense, is still the main center for finance in Europe. But until the end of the participation of the UK to the EU, London was also the main door for international investment, financial investment in the common market, in the single market. It works as long as the door is in the building. The door now is outside of the building, so that explains why Paris, Frankfurt, or Amsterdam as the new place for the financial investment in the single market, because you have to be part and inside the single market to work with us. To respect the regulations, to respect the supervision.
Michel Barnier, thank you so much for your time. I hope next time we get to do an interview face-to-face here in London. Michel Barnier, the former EU chief Brexit negotiator. Now, coming up, how big is the contagion effect on the banks? The drag from Silicon Valley Bank fallout continues in Europe, so we'll have more when we return. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Next week, Balance of Power is on the move. Starting Monday, March 13th, Balance of Power debuts at 5 p.m. Eastern Time, live from Bloomberg's Washington headquarters. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis at the intersection of politics and business. Balance of Power, weekdays at 5 p.m. Eastern, starting Monday. Only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, about 2 hours into the open, and European banks and financials really getting slammed, trading deep in the red. Investors spooked by the troubles overnight from Silicon Valley Bank, despite the bank's top executive calling for calm. Now, for more on all of this, we're joined by Bloomberg finance reporter Tom Metcalf. First of all, Tom, we understand a lot more about what's going on at SVB. Are you surprised by the contagion into other big banks?
Yeah, the ripple effects, pretty surprising, really. Just saw on the screen there, like Deutsche Bank down 7%. All these massive, big institutional banks really getting slammed. Obviously, we saw it in the US and now in Europe. And I think, it's partly that sentiment, the fear, the uncertainty. Yeah. And the other thing people are wondering is, maybe in a different form, how are these banks kind of also exposed to this disconnect between how much paper you've got and what time frame that is, and these very sort of mobile depositors.
Yeah. So what are you looking for in our reporting? I know we just spoke to David Essera, and he says, look, perversely, a lot of the big banks are getting slammed, but they could be safer than the smaller ones that aren't as diversified in their deposits.
Yeah, absolutely. That would be my take. Like, you look at a big bank like an HSBC, they've got, millions of retail depositors. They have a very, very different business model to a Silicon Valley bank. So I think, the risk there, maybe this is what shareholders are pricing in, is just this contagion. And yeah, that's the thing we're looking at. Two elements. One, are there any other banks like Silicon Valley Bank out there? And two, just what are investors saying? What is sort of the market going to do and react? And will it calm down, or will this sort of continue as the US opens?
I mean, some of the other questions are, for example, even if you're a big bank, you need to make sure that your deposits stay with you, and so you need to offer them more interest to basically entice them. And so does that change the revenue model?
Yeah, I mean, it's basically a bit of a flip on what we've seen previously, where you saw that net interest margin increase. And, increasingly with these interest rates stabilising, there's certainly not going to be many big increases going forwards. So, they do have to work a little bit harder to keep those depositors. But, I think whenever something like this happens, one of these, so-called bank runs, there's always going to be that, flight to quality, flight to trust. And, that's where I think those big banks are going to, actually benefit, because put your money with a JP Morgan Chase if you're worried about where it's going to be.
I mean, it's pretty ironic that also a lot of investors piled into these banks because as interest rates go high from the Fed, it seemed like a good place to be. But now we have to start revaluing some of the bonds that they're holding.
Yeah, no, exactly. Look, this is all dating back to that low interest rate era, where banks were really chasing yield. So the thing for folk to look out for, what were the lenders out there kind of chasing yield in stuff where you're going to have this sort of illiquidity on that side of things, but now with higher interest rates, you're going to be paying for it today, really.
Are there any other types of, I mean, in your question, very good question, I know we have reporters on this, is there anything like SVB potentially in Europe? When do we, I know we're investigating, but is this really the only other question that we need to try and answer in the next 24 hours?
Well, yeah, it's the sort of thing where you can kind of try and find out a similar, are there similar banks? And of course there are, but they'll be tech-focused, and they're probably none of them are like household names. The bank I always thought of in this sector was Silicon Valley Bank. When I was out in San Francisco, you really do hear and see it a lot more. Now back in the city of London, I think a lot of people will be like, who is this bank? What do they do? And I think that's reflective of, kind of the different economies. So for me, very West Coast focused.
Yeah, Tom, thank you so much. As always, Tom Metcalf, who oversees our UK banking coverage. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Anna Edwards here in London, and this is Bloomberg.
Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there wondering what happened.
There are many other banks out there, so it's very rational for investors to be asking, is there contagion in train right now?
Now, the question is, will this Silicon Valley thing have legs? Yeah, to a point, but I don't think it's cause for contagion.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Panic in the startup world. Prominent venture capitalists are urging portfolio businesses to pull their money out of Silicon Valley Bank because of fears about its financial health. The latest U.S. jobs report is out at 8:30 New York time. It could help determine what Fed policymakers do at their next meeting. And the summit in Paris. Emmanuel Macron and Rishi Sunak will try to end years of acrimonious relations between their countries. The meeting comes as the UK reports better than expected economic growth. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And boy, what a Friday, Chrissy. We've been asking for some time. As rates go higher and higher, what breaks? Well, I guess we know the answer to that now. Though, mercifully perhaps, I see that US futures are looking a little flatter.
Yeah, a little flatter. It's interesting, Anna, because today was going to be a pretty volatile day anyway because of the jobs report that we see stateside, or are going to see stateside in just a few hours' time. But we did not see the bank turmoil. Nevertheless, it is having a macro effect. Check out futures right now, lower by about 0.4%, potentially a little bit of a risk-off sentiment. I think that's really shown by what you're seeing in the 10-year yield. Because look, if you are expecting a hawkish jobs report, which, by the way, the consensus is, that would kind of pave the way for higher yields, not lower yields. Yet here we are seeing the 10-year yield at 3.85, really retreating even more from that 4% level, which shows you there is that global flight to quality, that global flight to safety that is showing up in the Treasury curve. So really kind of changing the game when it comes to that. Today's 10s curve, by the way, is the other one I want to watch, negative 99. Now that curve has kind of steepened just a little bit. We are still in inversion territory, but significantly less so than the 110 basis points we saw earlier this week. I want to, of course, talk about Bitcoin because that's going to be a major game changer as well. We're talking talking about SVP shortly throughout the show and in the coming hours as well. But Silvergate is also a major story, and that is affecting risk sentiment in terms of how much exposure you want to the cryptocurrency. A 19,000 handle on Bitcoin, down just shy of 2%. And I want to quickly talk about what happened overnight in Asia as well, because risk sentiment was pretty bad there too. Asia Pacific Index down about 2%, but a lot of the losses were concentrated in China. And you can really see that with the Hang Seng down about 3% overnight. And Japan, which has really been the outperformer in Asia in the last week or so, also not part of that this time around, down about, well, let's just call it up 2% to round up there. But to me, it's all about the BOJ when it comes to Japan. They stuck with their easing policy, no major changes there. It is the last day for their governor, of course, that actually creating a little bit of weakness in dollar yen. 136.74 is where we're at.
Let's have a look at the European picture then, Chrissy, and it's really red. And this very bright red suggests markets that are down by more than 1.5%. To what extent is this reflecting yesterday's story on Wall Street, I suppose, is important to ask, because this is really read across from what we saw in the banking sector, on the KBW index, and in the major banks over in the United States yesterday. So there's some read across from the US into the banking sector here. And when you're selling banks here, are you doing that because you think there is any direct read across? Possibly not. Are you doing it just because banks have done really well based on expectations of higher interest rates and higher net interest margins? Or are you doing it, are you selling these banks because you're concerned, you know, if there are uncrystallized losses on treasuries in the US, are there uncrystallized losses on other things here in Europe, maybe property? That was one of the conversations we had earlier. And given that, I picked a few companies to focus on today. This is a private equity business in Scandinavia, down by 8.8%. They invest, of course, in real estate, in some tech investments as well. And so you might expect that that sector would be in focus, and it is. That sector selling off. Sofina, Kinnevik, other names in that sector also weaker. Deutsche Bank, the German banking sector seems to be suffering here. Commerzbank is weaker. Deutsche Bank down by 7.6%. HSBC down by 5.3%. So it's pretty broad-based. The banking sector is the worst performing sector here in Europe, as if the market is selling first and asking questions later about whether there really are links, real ones or sentiment-driven links between these two sectors on different sides of the Atlantic. And we are talking about a flight into safety here in Europe, so selling stocks and getting into government bonds, and as a result, we see movement in the German 10-year yield. This is the buying of the bonds and the yields coming down, which makes a change from what we've seen of late, but it's not providing a boost to stocks, which it might have done if it were for other more positive reasons, Chrissy.
An element of panic across the world, Anna, and it's interesting, you're starting to see overnight even some of the commentary say, look, are we in a place where some of these banks could be perhaps too big to fail? At least that's the sentiment from some prominent investors. We'll get to that in a second. One of them, Mark Suster, warned against overreaction following SVB's surprise $2.25 billion share sale. Take a listen.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies. All throughout the global financial crisis, depositors were made whole.
Bloomberg's Danny Berger joins us now. Danny, now Silicon Valley Bank isn't necessarily a name you hear from around the world, but if you are in the tech capital of the world in Silicon Valley, this is one you hear a lot. Walk us through what exactly happened over there.
It really is a case of when we talk about unintended consequences from higher rates, this is one of them. To line out exactly what happens, it comes from this accounting quirk from banks like SVB. They're allowed to hold bonds on their balance sheet and not mark to market them if they call them held to maturity. So SVB had a lot of these. $91 billion is what they valued them at, a lot of duration type assets. The thing though is they probably weren't worth $91 billion. The Fed has been hiking, so the value of those has fallen significantly. Usually that's not too big of a deal, but what happens if your clients want money back and you have to sell those bonds? You're not going to get all of that money. So we know a lot of the VC space, VC companies, VC funds themselves, they've been burning through funding. They likely turned to the bank to get more capital, and SVB had to liquidate all of its securities and then, of course, release that statement that they were looking for a capital injection. So it is this mismatch that finally came to a head.
Danny, good morning. Let's think about some of the customers then for SVB. We were just hearing from a guest about, you know, there are deposit insurance schemes in place in the United States, and so that's worth thinking about when we think about customers in these situations. This is a bank that had a lot of VC funds as its customers. These are and the companies that these VCs invest in, of course. So what does it mean for them? What does it mean for the customers?
Right. Well, that insurance is $250,000. If you're a VC fund, it's going to be a whole heck of a lot more than that. So that is the problem, and already this problem stems from VCs having troubles burning through funding, needing more capital. So if they're struggling to get their capital out of a bank, if that happens, that's going to be a problem for them. There have been some reports that some VCs haven't been able to get their capital out of SVB. We've had other reports that, yes, they have been. So there's a lot of back and forth, but it's just yet another headache. They're likely going to say, okay, maybe we don't bank with the likes of these regional banks. Maybe we need to go to the big bulge bracket from now on to make sure this doesn't happen.
Yeah, maybe they want to put that, they're going to be looking to put that money somewhere, aren't they? Danny, thank you very much. Bloomberg's Danny Berger with the latest on what happened at SVB and what impact it has on the client base. Bloomberg's Valerie Teitel joins us now for a closer look at the broader market fallout from SVB's surprise share sale. Valerie, take us through what we've seen in markets here.
Look, the European session was a bit rocky this morning, Anna. HSBC, BNP Paribas, Deutsche Bank, Barclays, all shares plummeting. I mean, look at this Deutsche Bank share price down 7%. All of this due to the rocky close that the U.S. had yesterday. The big four U.S. banks losing a net combined market value of $47 billion. But let's check on how they're trading so far in the pre-market today. Those big four, Citi, Wells Fargo, Bank of America, they're sliding, they're continuing the slide today. A lot of these shares are down over 1%. JP Morgan down over 1%. Wells Fargo and Citigroup also nearing 1%. These four yesterday, as I mentioned, the slide yesterday capped a $47 billion loss in market value. Many are raising an eyebrow to this, Anna, saying these four U.S. banks, they're very large, they're highly capitalized, highly regulated. It's very unlikely that they'll have to sell those high-quality liquid assets, those treasuries, at a loss due to a deposit flight. So, you know, perhaps this is a dip that's going to be bought later, but the pre-market is showing a direction in the red.
Valerie, you know, it's interesting. That's the equity perspective. Then the bond perspective has some conflicting factors here. You're starting to see a flight to quality in the bond market, but then it's also competing with that narrative of 50 basis point Fed hikes. Square the two for us.
Yeah, it's just surprising the move we've seen in the two-year yield. This here in the yellow, that is when Powell made that statement on upping the pace. You can see that we have traded through that now. We're at a lower yield level now than when he mentioned that. The market has basically taken out that pricing in the two-year yield. Even what we've priced in for March, Critty, we were pricing almost 50 basis points exactly. That's pulled back a bit. It's now around 35. But the big question is, we were all very sure that a consensus print on NFP or even any slight beats on the payroll print number today would almost cement a 50 for the Fed. That narrative has gotten a bucket of cold water thrown on it today, that's for sure.
Yeah, things got a whole lot more complicated, didn't they? And this dynamic is also having an impact on the pricing of European rates as well. Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on the market fallout. Now, European banks falling here in Europe amid concerns of the SVB fallout. France is in the news earlier this week with Citi plotting a new trading floor in the capital as London struggles to keep up after Brexit. That set the stage for UK Prime Minister Rishi Sunak meeting his French counterpart Emmanuel Macron today. Joining us now from Paris is Bloomberg's UK correspondent Lizzie Burden. Lizzie, what does this summit mean symbolically?
Well, Anna, bromance is in the air. Rishi Sunak arrived at the Elysee just a few minutes ago, shook hands with Emmanuel Macron, and they both headed in for a bilateral behind me. It's really an opportunity to reset relations between the two nations after 7 years of acrimony, especially under Boris Johnson and Liz Truss. But Sunak and Macron seem to have much more in common. They're both ex-bankers. They both like skinny blue suits. And of course, they've laid the foundation with the Windsor Framework, the new deal on Northern Ireland. So they're expected to talk one-on-one, and you can see that their right-hand ministers are arriving as we speak to business leaders from both nations. And then they'll have a joint press conference at 2 p.m. London time. And then later in the month, of course, King Charles is going to be coming for a state visit. So really this is being presented as an opportunity, as a watershed to reset Franco-British relations. But as you hinted, it's a tricky moment for Britain as more banks choose to uproot staff to Paris.
Lizzie, they can't help the skinny blue suits. We'll give them a little bit of slack on that. In terms of substance, though, what can we actually expect?
They're not just skinny blue suits, there are mankles on show as well. But in terms of the substance, we're expecting a lot of discussion of defence, of course, because Russia is watching closely to see if there's a united front on Ukraine, particularly in terms of how the war ends. They also have some wounds to heal after the AUKUS deal, when Australia, the UK and the US signed that defence deal that tanked the Franco-Australian submarine deal. But Sunak's also going to want to bring something home for the domestic audience on small boats, stopping the flow of migrants across the English Channel. It's a very thorny issue, hard one to solve. Neither side will want it to undermine the rest of the talks. What Macron wants are boots on the ground, funding for police on the northern beaches of France. Sunak is expected to agree to that because it's cheaper than paying for asylum seekers in British hotels. But what we don't expect Macron to agree to is to take back asylum seekers who've already landed in Britain. He's likely to say that one's for Brussels.
Lizzie Burden in Paris on, of course, Sunak and Macron watch and fashion watch, I might add. We thank you as always. We want to continue to watch the drop in SVB. Right now, we are seeing the shares drop about 35% in the pre-market among some of the movers. Remember, we're going to be watching this throughout the day, as well as the contagion effect or assumed contagion effect across the financial sector. But this is not the only mover you want to keep an eye on this morning. Some earnings stories from after the bell, perhaps not going to be in the spotlight as much as they would before. I want to start with Oracle here, one of the major players in the cloud business, trying to break in, gain more market share from Microsoft Alphabet. They're actually down almost 4.5% in the pre-market. Their cloud sales missing those expectations, not gaining that market share that they were so after. And in the same tech space, I want to hit DocuSign as well. A pandemic favorite, DOCU is our ticker, down just shy of 7%, 6.5% lower on the day. Their billings forecast missing their estimate. When we're talking about business investment, DocuSign is going to be a great kind of poster child for that, whereas investment into AI, into cybersecurity, those are doing well, perhaps not in these kind of technologies anymore, which really increases the need for them to diversify. I want to switch from tech and go over to the retail sector. Gap is catching my eye. GPS, another downside story, down 8.5%. A simple one there. Their sales are missing estimates. It's kind of something you're seeing in the retail space all across the board. If you were not able to capitalize on that higher income consumer, the wealthier consumer, then your sales are probably not going to come in as high. That's simply a function of inflation and some of the issues plaguing the retail space, Anna.
Chrissy, coming up on the programme, much more ahead on the SVB fallout. We will discuss with Sophie Lund-Yates, equity analyst at Hargreaves Lansdown. Does the extent of selling that we're seeing in European banks today, does that really make sense? What is the contagion we need to discuss? And what contagion fears do we dismiss? This is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
banking system is, the less the Fed can do. So I'm looking at the banking system, not because it's going to go out of business. Silicon Valley's had a great business model for a long time. They've just recently made some mistakes. I don't think this is a one-off event, but I don't think it's going to be contagion for the banking system. So I think this is going to blow over, but I think it's going to permanently damage what the Fed can do as far as just raising rates and being as hawkish as we've seen Mester and Bullard over the last 6 weeks.
Andrew Brenner there of Natalian Securities speaking earlier to Bloomberg Television. Joining us now is Bloomberg cross-asset reporter Denitsa Sikova. Denitsa, you picked a great date to be on television. There is a lot going on for sure, but I want to start with kind of the competing forces we have right now, both in the equity market and the Treasury market. Of course, the U.S. jobs report going to set the tone for the Federal Reserve. At the same time, you have this risk-off sentiment coming from the chaos really spurred on by the Silicon Valley Bank and the funds outflows from there. So square the two for us. What do you see as the bigger game changer for today's session?
Yeah, for sure. We're kind of seeing a big reversal from the more hawkish message we've seen for a while. Obviously, everyone has been flocking to financial sector to kind of protect from this historic hiking cycle. But now we're seeing that there is obviously the opposite effect from that hiking cycle as well. And in terms of job data, everyone has been so focused on it. People are not expecting, obviously, as hot print as in January, but this is a very sensitive matter, especially with what we've seen from Chairman Powell and his more hawkish remarks about higher for longer, and those concerns obviously remain. Today, we've seen a big flight to safety. Obviously, if you look at the 10-year, it's at the lowest level we've seen in 3 weeks. We've seen a really big repricing in terms of how many rate hikes we're going to see, how high we're going to go. So there is really two competing forces. It's really going back to how hot is going to be that job number. We've seen some weakening. We saw the jobless claims. We saw quit rates. So there are some hopes that that number may come a little bit cooler.
Okay, so there's a lot of hope and expectation around the jobs report later. It's going to land in a complicated market because of the SVB story. And with that in mind, Denitsa, I mean, does it make sense to investors, do people you talk to think this makes sense, that we're seeing European banks sell off to the extent we are? Some of the German banks down by more than 7%.
Yeah, I mean, it's the same with bonds. We really see a worldwide move at the moment. I would say the majority of experts I have talked to say that this contagion will likely be contained and it may not be as big of an issue. But of course, investors have been looking for something to break for so long. There is a lot of economic data coming in. There is a lot of anxiety in markets.
Connection lost.
Markets are mostly neutrally positioned, so they're looking for any sign to kind of increase or decrease exposure. So it's a very sensitive moment with a lot of data coming in, a lot of anxiety in investors.
Yeah. And this was a sector that was vulnerable, I suppose, given the strength we've seen and a lot of expectation around those net interest margins as rates were on the rise. Denitsa, thank you very much. Bloomberg's Denitsa Sikova joining us there on the markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. This is Bloomberg.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly.
I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
DOJ or other authorities
could face bigger challenges next.
was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. The Bank of Japan maintained its easing stance in Governor Hiroki Kuroda's final meeting. The move hit the yen and bond yields. The BOJ's decision coming shortly after Parliament approved Kazuo Ueda to succeed Kuroda next month. China's Xi Jinping has cemented his effort to consolidate power. Lawmakers unanimously voted to give Xi a third 5-year term as president. That demonstrated his unrivaled grip over the Communist Party. Xi has effectively discarded the collective leadership approach that China has used since its reform experiment began in the late 1970s. In Washington, it was the opening shot in high-stakes negotiations between Democrats and Republicans over the debt ceiling and government spending. President Biden unveiled a $6.9 trillion budget proposal that includes $5.5 billion in tax hikes over the next decade. It's certain to be rejected by the Republican-controlled House. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders are expected to agree to let European firms benefit from some of the battery subsidies offered only to U.S. producers. Anna, it is a very busy Friday, as we just laid out, but I got to say, I think SVP and the chaos in the banking industry is potentially taking the cake.
Yeah, absolutely. It seems to be pushing the jobs report, which of course we wait with great interest, pushing it to one side. We're seeing the spillover from SVB pop up in some really unlikely places, and I will just flag as one of those. Swedish pensions. The largest Swedish pension fund, Electa, is thought to be the 4th largest shareholder in SVP, and the fund says this is only 1% of assets. It'll have no impact on solvency, but it just goes to show where these linkages exist and what comes to the surface when these things happen. Right, coming up on the market on the program, we'll take a bigger picture of what this means for risk assets. Sophie Lund-Yates joins us from Hargreaves Lansdown. This is Bloomberg.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Panic in the startup world. Prominent venture capitalists are urging portfolio businesses to pull their money out of Silicon Valley Bank because of fears about its financial health. The latest U.S. jobs report is out at 8:30 New York time. It could help determine what Fed policymakers do at their next meeting. And the summit in Paris, Emmanuel Macron and Rishi Sunak will try to end years of acrimonious relations between their countries. The meeting comes as the UK reports better than expected economic growth. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today, and we're all looking for signs of cooler heads prevailing here today, Kriti, after the day that was yesterday on Wall Street. That might not be true of European equity markets just yet, but I can report that NASDAQ futures have just turned positive.
Yes, just barely, but you know what? I think it speaks to risk sentiment in general souring. Now stick with me, I'll explain how that works. Essentially this idea of flight to quality that you are seeing in treasuries, well, it applies to tech too. It's the classic trade. If you are worried or if there's a crisis anywhere in the globe, you buy American, you buy American tech. And that has been a dynamic going back, I want to say at least 10 years you've seen in the markets. Nevertheless, the S&P 500, I think from that dynamic, perhaps pairing some of the losses you saw earlier in the pre-market session, futures now down only 0.2%. They were down almost 0.6% earlier, like I said. But the 10-year yield is really what's catching my eye because conflicting forces today in the bond market. On the one hand, you have that flight to quality, that flight to safety that I was just talking about. On the other hand, you have those inflationary pressures, simply the idea that a 50 basis point hike might be supported after the jobs report today, 385 on that note. And I think that conflicting kind of contradictory narrative is really shown in the 2-10 spread. Negative 98 on that inversion really shows you that the bid into the long end of the curve is actively competing with the sell-off on the short end. So you can really see that showing up in a little bit of steepening on the 2s and 10s. Nevertheless, Bitcoin is really where it all started, that risk sentiment affecting the cryptocurrency as well. That's one place where the losses are certainly souring down about 2% and 19,000 handled there. But of course, the chaos on Wall Street right now and around the world really sprung by one name, Silicon Valley Bank, SVB. Shares are down about 39% in the pre-market. They were down 60% in yesterday's session, another 20% after hours, and are still continuing to drop as people really just head for the exits with that company. A couple of earnings, though, to put on your radar as well. Oracle is top among them, an 83 handle down just shy of about 5%, 4.4% to be exact. After their cloud sales missed expectations, they're trying to gain market share. They weren't able to. DocuSign as well, down 7.8% on the day. Their billings forecast also missing estimates, not reaping the benefits of that business investment you're seeing some of their peers get. And Anna, lastly, Gap shares down 8.5%. A lot of doom and gloom this side of the Atlantic, I've got to say. Also missing estimates. I guess people just aren't shopping at the Gap at every corner.
Right. Well, I'm not sure I can bring you anything other than the gloom here in Europe as well, Chrissy. But it is a little bit of yesterday's gloom, if that's any consolation. This is catching up with Wall Street, really. Substantial losses on Wall Street yesterday, filtering through into European equity markets and the banking sector, and other money managers certainly taking the brunt force of that. So this is the Stocks Europe 600, down by 1.5% today. And here are some of the banks that are leading us lower. Nearly all sectors in negative territory. Only utilities is a standout to the upside. Banks, financial services, all of those really very much in focus. Private equity names over in Scandinavia and beyond, also under pressure. But this is the banking sector here in Europe. Here's two names under pressure. Deutsche Bank, one of the biggest drops in percentage terms, and HSBC, one of the biggest weightings on the Stock 600 in terms of that downdraft today. Here's the German 10-year yield. This is, of course, the flight to quality that, Chrissy, you were talking about, but this is it expressed between asset classes, so getting out of stocks and into bonds, and as a result, we see a bit of a retreat in the yield, which, of course, falling yields would have been something that would have supported equities had we been talking about a very different driver, Chrissy.
Yeah, it's interesting. The tide is turning very quickly in the cross-asset space, but let's bring it back to that equity market story that you were just referring to, because it feels like tech isn't necessarily the focus today, as it would be with that yield move. Instead, it's financials. Joining us now to break it all down, Sophie Lund-Yates, equity analyst at Hargreaves Lansden. Now, Sophie, this is interesting to me because on the one hand, higher rates, or the expectation of higher rates, should be a boon to the financial industry, yet the idea, or the PTSD, for lack of a better term, of kind of the global financial crisis and some sort of banking meltdown seems to have everyone headed for the exit. How much of this move is an overreaction?
That is an excellent question, because to be really honest about it, I think we are actually seeing quite a large degree of overreaction. Really, the way that I would phrase this, again, I'm also wanting a better phrase, this is a little bit of a storm in a teacup. Really, the challenges that we've seen from SVB, really don't necessarily spell out, you know, a kind of this doomsday scenario for other major financials. We are seeing downgrades in the valuations of a lot of the major financials' bond portfolios. That is going to cause a bit of a bump in the road, but really we aren't seeing the markers for a full-scale financial wipeout or meltdown at this point, I would say.
Okay, so maybe this is a little overdone. Good morning to you, Sophie. What about what this signals about the US economy? We've been asking what breaks, and maybe this is the way that weakness in the tech sector sort of spreads into other sectors and just reminds us of difficult times as rates go higher. Is this a sort of early warning sign on the US economy?
Yes, I think it definitely could be. I think to put some nerves into perspective, you know, the chances of a 50 basis point increase from the Fed at the next meeting has gone from 29% chance just last week. That's now well over 70%. So nerves are really very heightened, and you know, stocks that are viewed as overvalued, largely in the tech space, really are quite vulnerable. The flip side of that, and to try and find a bit of brightness, I would say that what we are seeing is that valuations in the UK and Europe, as a direct effect of all of this, are actually looking a little bit more, or even more compelling. You know, they're continuing to trade below their long-term averages, and that does suggest the risk that's going on, but also I'd say it's quite a compelling story that's going on in the background here, and potentially an interesting entry point.
Okay, potentially a buying opportunity then when it comes to if you have a positive view on what happens for European and UK stocks. What about the banking sector, Sophie? Because clearly the banking sector has done really well in recent months with rates on the rise, net interest margins going higher, and investors expecting that to continue. Is this just makes us think twice about that dynamic, I suppose?
Yes, certainly. Obviously, banks are economic bellwethers, and particularly we know this has a huge bearing for the UK market. You know, financials are a huge weighting over here for the market as a whole. But really, I think the banking sector in aggregate is actually very resilient. When we look at those capital ratios, when we look at the balance sheets, they simply aren't in the same position that they were in the last financial crisis. So that's really compelling. At the same time, we've seen record buybacks. You know, they really are sitting in massive surplus capital positions, and that shouldn't be knocked. And also at the same time, I think something like your classic banks, really interest rates of 2 to 3% are the sweet spot, really, in terms of you're not looking at massive economic contractions at that point, but you're also able to make a bit of money on your services. And I think that while things are very tough right now, we are starting to see the cloud shift ever so slightly. When we look beyond this year to the middle of next year, end of 2024, we could see that sweet spot emerge again for the banks.
Sophie, I want to really zero in on the Federal Reserve here. After the jobs report today, a lot of expectations of some repricing, some major calls from banks expected as well about whether 50 basis points is validly on the table. If we do indeed get that 50 basis point hike on March 22nd from the FOMC, does that step up create more issues from a sentiment perspective as opposed to the actual margin of the move?
Yes, I think so. I think that's absolutely right. And I think particularly the thing that we need to be watching out for is whether or not the market is about to start pricing in a 6% as the terminal interest rate. And I think that is what is the likely outcome if we see a stronger than expected jobs report later on today. And at that point, I do think that we could see, purely from a sentiment perspective, some equities, particularly those that are more in the growth area, really come under renewed pressure. That said, very, very sharp shocks won't happen unless something exceptional comes out. By and large, markets know that there is economic contraction coming. It's whether or not that jobs data is particularly off the charts. As a bit of a marker, I would say that an uplift in equities could be seen if we see job additions come in under 200K. But that is a big ask.
Sophie, thank you very much. Thanks for joining us. Sophie Lundiates of Hargreaves Lansdown with thoughts on the markets. Coming up, more on the fallout from SVB. We will speak with the founder and chairman of Target Global, a venture capital firm. How tough is it out there with rising rates for VCs and the unicorns that they back? We'll get to that conversation shortly. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
Shana Cecil, President and CEO of Banrian Capital Management, speaking on the risks of contagion from the crisis sparked by Silicon Valley Bank, SVB. Panic has spread across the startup world due to worries about the financial health of SVB, a major lender to fledgling companies. Shmuel Shafetz is founder and chairman of Target Global, a venture capital firm, and he joins us now. Shmuel, really good to have you with us. Tell me, in a rising interest rate environment, how tough is it right now? What is the daily experience for VCs as rates go higher, the cost of money on the rise?
Well, it's definitely not been a phenomenal year, right? 2022 was, I think the second half of 2022 was probably the quietest I've seen in the 15 years I've been doing this. But it has to be taken in perspective of 21 and 20, which were obviously phenomenal years. So I think there's still a lot of fuel in the tank for a lot of venture-backed companies, for a lot of firms. So it's definitely not a sort of 2009 kind of catastrophe. It's just sort of naturally slowing down. But of course,
and SVB, slowing down. And SVB clearly played an important role as a banker to VCs and startups over in California, Shmuel. What concerns you about what seems to be a really difficult period for SVB? What concerns you about what impact that will have on VCs and the businesses they support?
So first of all, it played a very important role globally. We're European investors, Israeli investors, and SVB is a big part of our business as well. I think SVB in the end is a community bank for a relatively small community of investors and of startup companies. And they're experiencing what I think everybody in this industry are, this hangover from 21, where they had a perfect storm, both sort of macro and the micro of this industry. And also this unique nature of the way startups raise money, where they get funded. They got funded with a lot of these mega rounds, money for 2, 3, 4 years in 21, and they're spending it. They don't have any earnings. So they start to spend it down, and SVB obviously got a lot of benefit from money coming in 21. And now, as companies are starting to deplete their reserves, it's just, I think money is going out the door organically. It also seems, and I'm far from being a banking expert, it also seems like they did some things that probably looked reasonable in 21, early 22 with the additional capital, and now with rising interests have become a problem, particularly a cash flow problem. So I think definitely it's something that's on everybody's minds. You have to remember the startup industry is very networked. Right. Everybody sits on boards, everybody talks to each other, and in the last week, every board I'm on has had this conversation of what do we do with our SVB money? And I think it has become almost an unreasonable decision to keep it. It's become a very difficult decision to say, well, we're going to keep it, we're going to take that much risk. Right. And it's also important to remember for a lot of startups, SVB is their only bank.
So just to confirm here, if we can, are you currently a customer at SVB?
Our portfolio companies are customers for many years. We have a great relationship with the bank. It's been a very good partner for all this, for the whole industry, right? You have to be, SVB is a great service provider in the tech industry. They've really have this niche down. They're lenders to a lot of startup companies. They're a real partner.
So it sounds like you're not pulling out your fund the way a lot of others are. Let me ask, what would it take for you to be spooked?
So first of all, I think we are definitely seeing companies pull out money, right? And we're definitely seeing companies take deposits out to other banks that are more stable. I think it is a very scary moment for SVB, and I think probably we'll need some intervention to get confidence levels back.
Does this incentivize you to diversify at the very least? Maybe not pull your entire funding from SVB, but at least put it elsewhere?
No, for sure. Our portfolio companies are definitely taking money and diversifying their banking relationships, and they have for the past few days, right? I think it's very clear. I think it's something that, as a fiduciary, as a board member, you have to sort of support in portfolio companies.
Yeah, and with that in mind, Shmuel, I mean, is the startup sector, has it allowed itself to become too reliant on one supplier in this space? Is that something we need to learn from?
I don't know if the startup sector has become too reliant, but I think definitely SVB is a systemic risk for the startup world. So again, because of the nature of this world, even a delay in withdrawals, not to mention the bank failing, but even a delay will cause a ripple effect through this industry. Companies will just not be able to pay salaries. So I think SVB is systemically important for our industry. That's definitely true.
Well, speaking of that importance, let's talk a little bit about liquidity here. We've heard some reports from our Bloomberg reporting has been all over this, that in some cases, folks haven't even been able to access the website or even try to withdraw their money. Have you come across any of those issues? What is SVB telling you as a customer?
So we have not, I have to say. We've been getting, again, it's across multiple portfolio companies and boards that I'm on. We've gotten good service. We've gotten very reasonable answers from the SVB people that we were working with. So I have to say that we haven't experienced any of those problems.
Where will the money go, Shmuel? It comes out of SVB. Where are people sending it?
I mean, I think people are sending it either, we're not American investors, so most of our companies have an operating bank in Europe and Israel. A lot of that money is probably going there. Some of it's going to more traditional commercial banks. I hope some of it will be able to get back to SVB as things clarify, as we see that the bank is doing the right things. I hope we can move money back.
Okay.
And also support it.
Shmuel, thank you.
Building.
Thank you very much. Thanks for joining us. Good to get your perspective. Shmuel Shafetz of Target Global. Thank you so much for joining us. Coming up on the program, the latest US jobs report is due in just a few hours. We'll preview that next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's happening ahead in the trading session. UK Prime Minister Rishi Sunak is meeting with French President Emmanuel Macron in Paris, the first summit between the two nations in 4 years. European Commission President Ursula von der Leyen is in D.C. today. She's meeting U.S. President Biden. And U.S. Treasury Secretary Janet Yellen will discuss the budget at 9 a.m. New York time. Meanwhile, Apple will hold its annual shareholder meeting virtually at noon. And the key focus, of course, today is the jobs report, 8:30 a.m. New York Times sharp. Joining us now, who else for a preview on the jobs report than Michael McKee, Bloomberg International Economics and Policy Correspondent. This is a Super Bowl, I'm told, right? This is your Super Bowl.
I don't know if it's my Super Bowl. I was saying earlier, I'm old enough to remember when the jobs report was the number one story. It seems like
just yesterday.
Yeah. But we are expecting what would have been a strong jobs report in the past, with 225,000 jobs created in the month of February. But after the January number, 517, there is going to be a lot of focus on whether we go higher or lower and what that means for the overall economy, because that sets the stage for, does the Fed do 50 or does the Fed do 25? Keep an eye on the unemployment rate. That's the one that Jay Powell got a lot of flack for up on Capitol Hill. Does he sacrifice jobs? But 3.4% is the lowest in decades and doesn't look like it's going to move, according to economists surveyed by Bloomberg. And then the final question, average hourly earnings, of course. Are we starting to see earnings come down? That'll be another key question. So a lot to unpack in this jobs report, but it's going to play second fiddle unless we get a real surprise today, I think.
Yeah, Mike, link it to SVB if you can, because we're talking about one sector in particular that's taken us into maybe a new stage of the U.S. economic cycle, or flagging perhaps that we're entering one. This is the tech woes, of course, and Silicon Valley synonymous with that. Is what we're seeing at SVB, is some of the difficulty the tech sector is facing, is that coming across in the jobs reports?
Well, interestingly enough, it is not so far. You take a look at the chart that we have here, basically a chart that shows computer workers. Tech's hard to do because there's a lot of different categories, but basically computer design and the people who are in the mortgage banking industry, in banks, in credit intermediation. And tech workers are just finding jobs. The line is not going down at all so far, whereas we're starting to see a loss of jobs in that mortgage business. Now, back in 2008, when we went into the financial crisis and housing crash, you can see how many bankers lost their jobs. This is nothing like that. And that's kind of the question so far is, has the Fed gotten something done? Because the job losses are concentrated right now in a little bit of housing and not anywhere else, not showing up anywhere else. And so that's going to kind of play into what we see today.
And I think some are talking about some weakness in construction, but again, that's linked to housing, isn't it, Mike? Is this going to be a month where revisions matter a lot, given that really blowout number we had in January?
Well, it could, and that is, do we see that number from January revised? 517 took everybody by surprise. Does that come down? Could it possibly go up? There were a lot of statistical reasons why it might have been wrong, and also good weather in January may have played a role. So there is a strong possibility of a revision. We just don't know in which direction or by how much. If it turns out to be an outlier, then the Fed is okay with perhaps 25. But if we're seeing more strength than we anticipate, then the Fed is going to have to probably raise rates more and farther. And the whisper number on Wall Street, interestingly enough, has gone up over the past 24 hours. Now Wall Street's kind of leaning towards 250 instead of 225.
Well, Mike, very quickly, 30 seconds. The estimate 225, as we pointed out. Economists saying 225, just meeting that estimate is still enough to support 50. Is that what you're hearing as well?
Well, I think it would, because it's the dominant view on Wall Street, but a lot's going to depend on the CPI report next week. If inflation is up, definitely 50. If inflation came down a lot, it's going to be a much closer call.
Bloomberg's Michael McKee all over it. He'll, of course, lead our jobs day coverage at 8:30 a.m. New York time. And on top of that, we're going to get the White House reaction with U.S. Secretary of Labor Marty Walsh. That interview coming up at 9:30 a.m. New York time. A lot to digest here, of course. A lot happening on surveillance. Up next is, of course, surveillance, Anna. We're going to hear from former Fed Governor Randy Kroszner, among others, really talking about the market reaction here. I imagine the twos, tens inversion is going to be a big hot topic. Stick with us. Tom, John, and Lisa take it from here. This is Bloomberg.
go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're still looking at a labor market that is extremely strong.
This more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish.
It's all about the trend, and the Fed wants to see a downtrend that's convincing.
The market might be a little bit too fixated on this kind of will they, won't they question of a recession.
I think Powell muddied the water a bit this week, for sure.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Who remembers Payrolls Friday?
Yeah.
What happened to that?
See you.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures down about 1/3% on the S&P. There's only one stock to watch right now. Tom, it's SVB Financial Group. Their stock is down another 40% in pre-market trading.
It's jobs day for 8,553 people in Santa Clara, California. The good news, John, is we're going to do what surveillance does. Gerard Cassidy will join us. Michael Mayo will join us, and what they're going to tell you is this is idiosyncratic. This is not 2008.
The SVB CEO apparently told clients, stay calm, Tom, and then VC after VC came out telling their companies to pull their money. What do you make of that?
I call it a run on a bank, but Jimmy Stewart's not in the movie. What's important here, and this is Bloomberg Intelligence, Herman Chan and Sergio Ferrar overnight did fabulous work on this. This is basically two bond portfolios segregated, and they got to figure out what to do with them now that those said deposits are walking out the door. Most of the experts I talk to say they've been clumsy at it. To be kind.
Well, let's talk about why some of those deposits are walking out the door. So you mentioned Mike Mayo of Wells Fargo. He put out this in the last 24 hours. SIVB is the worst case. The core issue at SIVB is a lack of funding diversification. SIVB deposits are from VC, which has its issues. To us, the larger the bank, the more diversified the funding. And Lisa, I know you agree with that point from Mike Mayo.
That's been the big distinction of why, to Tom's point, this is not 2008. This is not going to be some sort of mass banking Armageddon. What this is going to be is increasing challenge in the smaller regional banks that don't have that diversification and are competing for deposits in a higher interest rate regime where suddenly that's going to erode profitability and potentially force them to sell to shore up with assets that otherwise are held to maturity.
John, I don't want to bury people down with a lot of math right now, a lot of CFA baloney, but this is from Bloomberg Intelligence. This is the Silicon Valley Bank. They have deposits that have grown 180% over pandemic time. Their securities, that portfolio Mr. Mayo's talking about, grew not 180%. They're supposed to match, sort of, 313%. First of all, I've never thought about it. I've never seen it. And as Mike Mayo and others are saying, this is basically a bond portfolio wrapped around a bank.
So let's be very, very clear. Quite normal in banking. And Lisa, you're perfectly positioned to talk about this. This isn't a problem if you can hold those securities to maturity. This becomes a problem when you have to sell and those securities are underwater. And as we know, Lisa, given the bond action we've seen in the last 12 months or so, some of those high quality assets, if you mark to market right now, there are some losses.
And part of the problem is that you don't see the losses because you don't have to identify the mark-to-market losses of the hold-to-maturity balance sheet in the quarters that lead up to an issue until you have to sell. Here's the problem. If you start having to sell some of these assets that haven't repriced, what happens to some of the less liquid debt? And this, I think, is the broader market question. What happens to debt that people thought, oh, maybe it's not going down because we're not seeing the pricing action?
First thing I did when I came in is I looked at the Bloomberg total return set of indices on corporate, on high yield, on full faith and credit. We haven't broken down there. To Lisa's point, John, if we see higher yields, if we see price down, does this idiosyncratic hat trick, let's call it that this morning, we haven't even mentioned BitDog, but the bottom line is, do these little events like Silicon Valley drift over into other major banks?
So let's be really clear here. That word you keep using, idiosyncratic, you're going to hear it a lot this morning. But I want to be clear about something as well. There is a challenge now to the broader banking universe. Mentioned it a few times already in our coverage in the last 24 hours. There will be a competition for deposits, and the banks will now have to respond to that. So Betsy Graysock at Morgan Stanley, she's published too, Tom. Fantastic bank analyst, she makes the same point. She doesn't think we've got a big liquidity problem in the banking system, but she acknowledges this. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS. Lisa, we're now at that point in the tightening cycle where it's high rates are great for banks until they're not. We're at that until they're not stage of things.
Exactly, because deposits are starting to leave and banks are starting to care. Remember when we were talking about there were so many deposits in the banking system that if they lost them, it would be a good thing, then they wouldn't have to deal with the other assets. Now it's really a problem.
John, I know we got to move on here, but this is so important. Everything's fine and on the income statement, and that's the way banking is. Rates go up, banks do better, until you come over to a balance sheet analysis. I know it's Jobs Day Friday. It's also Balance Sheet Friday. All of a sudden, with these banks, these idiosyncratic moves, we are looking at balance sheet analysis and not income statement analysis.
5 minutes in right now. Let's talk about that jobs number just briefly, 225, in case it doesn't get squeezed in the next 10 minutes or so. I'll whip through the price action for you just briefly. Futures are negative about 1/3% on the S&P. Yields are coming in about 4 basis points on a 10-year, 386. Just a massive move at the front end of the curve yesterday. 2-year yield lowered by 20 basis points.
Huge move, yeah.
Lisa, a 20 basis point move going into payrolls. And can we say this, Lisa, do you think it's fair to say that Chairman Powell probably doesn't want a hot print today, especially after the price action in the last 24 hours?
100%. He was trying to back away from saying a 50 basis point rate hike was a certainty. A hot print would make it almost an impossible aspect to avoid. He would have to be at least having a discussion about why he is not raising 50 basis points. 8:30 a.m., we do get that number. We also get average hourly earnings. The range of estimates on Wall Street for the just headline number goes from 300,000 down to about 200, 150,000 on the low end. Average hourly earnings might be more important. How much do we still see employees able to charge bigger and bigger pay increases? And then what's the read through in terms of, to your point, John, what this means for the expectation of how high, how fast the Fed has to raise rates? And I do wonder, in some ways, are we seeing something break in certain parts of the financial sector? Does that give the Fed a reprieve at all, or does it not? Because inflation is at the forefront of their consideration. Today, President Biden is meeting with European Commission head Ursula von der Leyen. They're discussing that trade clash over the $369 billion Inflation Reduction Act. And then staying in Washington, this is also going to be really interesting to watch at 9 a.m. Treasury Secretary Janet Yellen is going to be testifying in front of the House, talking about the debt, talking about Biden's budget. How does she really parse through what interest rates mean and what she thinks the consequences of expanding spending versus some of these tax increases potentially could be, John?
Hey, Lisa, great work as always. Let's get straight to Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, great to see you, sir. What a morning for it. Let's start here. What did you make of what was unfolding just yesterday through the session into the afternoon?
You know, I think, John, the word idiosyncratic is probably right, but here, that's not the issue. To me, the issue is we're at a situation, the Fed senior loan officer survey, it's never showed this kind of tightening and lending standards without being near a recession or in a recession. So is this SIVB situation going to create easing or even more tight lending standards? So the problem that the market has isn't necessarily just SIVB. It's where are you going to get the money? The bank lending standards are at a point that you've always been in a recession. You know, we could cover the yield curve ad nauseum, over 93% of possible yield curves between 3 months and 30 years. So pick your favorite yield curve, 93% of them are inverted. So there's and we're already at full employment. So the sources of increased money to buy things, do things, invest in things is really drying up, and this didn't help it.
Yeah, I really agree with that, Tony, the idea there that money is going to be the new plug given the new interest rate regime. Tony, it's simple. I was talking a year ago about the great zombie roll-up, and we're now there. And yet you and I know from our experience back to Robert McTeer and the savings and loan crisis that banks don't roll up. The government steps in and fixes these things before they roll up. Is what we're seeing in bank tension nothing more than part of the great zombie roll-up given new rates?
Well, it's an impact of the fastest rate hike cycle in history. Faster than Paul Volcker. More significant on an early basis than Paul Volcker. And I'm kind of known, as you guys know, I'm kind of known as a permeable. I've always been that way when money is available. And it's the opposite when money is not available. So we have this idea somehow that we're going to have a soft landing in a place where you've got a generationally levered system, and we're finding out what that means. Not necessarily in where people look. It's never where people look, Tom. It's where people can't see. And where they can't see is the biggest growth area of finance in the last 15 years is private equity, private credit, and venture. So when we look at all of these factors, the idea that we're going to have a no landing or a soft landing in a generationally levered system with the fastest rate hike cycle in history doesn't make a lot of sense to me. No, it's not the banks are blowing up. The problem that we have is employment. We're going to get the number later. Employment goes down on an escalator and up on an elevator. And there's always a catalyst that makes it spike like that. And the catalyst is typically when you have a money shutdown and companies have to lay people off quickly.
A money shutdown, which we haven't seen yet. I am wondering, Tony, when you say you're the opposite of a perma-bull, perhaps a perma-bear, when money costs something in a tighter financial conditions, what does it mean to be defensive at a time when people over the past couple of months have been saying, go into the big banks? That is the defensive trade in equities.
Right. So to give you an idea of what the bank performance has been like, right before I came on air, I looked at it. So the 3-day rate of change on the KBW Bank Stock Index is down 11.96%, 12%. The only times I can find when I look back at that, going back, a few cycles is 1998, 2002, 2008, 2011, August of 2015, and 2020. So clearly the banking system is telling us that there's some kind of issue here. And I would say, Lisa, that money has been shut down. Real liquidity is measured by M2 money supply. The first time in its history that I can find, in the data that I can find on Bloomberg, the first time it's had negative year-over-year movement. Now, granted, we had an incredible amount of liquidity coming out of the pandemic, but people spent that. That's the whole inflation and hyper-growth story we've already seen. When you've already spent it, you can't just say, oh, well, we're offsetting the pandemic liquidity, because it's gone. You need new money.
Yeah.
And the answer is nothing that I can see here is creating new money. But we've been in this for over a year. I've been in this situation and feeling this way for over a year. That's not the time to go running for the hills. It's time to think about what you want to buy when you get that final leg lower, that third leg lower. Bad news becomes bad news.
Just 30 seconds here, Tony. Do you think that what we're seeing over with Silicon Valley Bank will change the dial at all for the Fed and how far they're willing to hike rates?
I think it's yes, because I think it gives them an idea of what can happen in things they can't see. The Fed does not have oversight on private equity, private credit, and venture. That's where the real liquidity squeeze has come on the rise in rates. And I think it's going to give them an idea of what this rise in rates means to small companies and emerging companies, which are really the heartbeat of employment.
Hey, Tony, this was wonderful. Just great to kick off this morning with you. Thank you, sir. Tony Dwyer there of Canaccord Genuity. This is the potential to be an absolute nightmare for the Federal Reserve. You get a hot payrolls print later this morning. You go again next week on CPI, and you face the prospect of needing to back away for financial stability issues before you've conquered inflation. Can you imagine having a conversation about going 50 basis points when there is a single bank in the United States facing a run on itself?
This is a nightmare, and it's something that I was thinking a lot about last night. What happens if we do get a hot print? What do we have if we've got stagflation, essentially, but even worse than that, where you have companies that are feeling the effects of higher rates, but it isn't working to curtail inflation? This Federal Reserve has to address inflation. When you take a look at rate hiking expectations, we're still baking in about 5.5% by the end of September.
Gerald Cassidy is going to join us later in the hour. We're going to catch up with him in about 17 minutes' time. Tommy just published, he said this: we believe yesterday's bank stock sell-off was overdone. A lot of the analyst community share that view this morning.
I did a very careful technical analysis of the big banks. I looked at 3 different series, including Standard & Poor's, DIV, and I looked at JP Morgan as the mothership. They did not break down. They pulled down to new levels. I get it, but I'm fully in support of what the gentleman from Tucker Anthony and RL Day says.
Nice. You got the full resume ready to go.
Well,
that's useful. That's good.
good.
I think this morning we have to draw a distinction between existential issues and profit headwinds. And we'll talk about profit headwinds for the broader sector with Gerald Cassidy as well. That's coming up. Futures negative 1/3%. Apparently it's still payrolls Friday.
For now.
Names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, today on Bloomberg Television and Radio.
This is just pure panic. So I think it's a one-off, intimately linked to the Silicon Valley and tech bubble. Today it's a reminder that you should keep your deposits only in heavily safe, deposited, and well-regulated large institutions. When people chase returns or services in small financial institutions, they always run a huge risk.
That was Davide Serra there, the founder and CEO of Algebris Investments, catching up with Francine a little bit earlier on this morning. If you are just tuning in, equity futures are still negative. No drama here, though. We're down about 0.4% on the S&P 500. The drama continues with Silicon Valley Bank. That stock is down in the pre-market by close to 42%. The broader banking universe yesterday, the KBW Banks Index, very much followed very closely in the United States, down for 4 straight days. This week, we are heading for the biggest weekly loss since spring of 2020. That just gives you an idea about the magnitude of the move that we've seen so far this week. We will catch up with Gerard Cassidy in about 13 minutes' time. As I mentioned a little bit earlier, if you missed it, he did publish a little bit earlier this morning, Tom, about 10 minutes ago, and he just said this: yesterday's bank stocks sell-off overdone. The analyst community on Wall Street are making the same point that what's happening over here is very, very idiosyncratic, and what's happening in the broader banking sector is a profit headwind story that we can build on a little bit later.
We don't need a CFA clinic now, but what's really important here is to look at selected ratios, compare and contrast. I want to compare Silicon Valley Bank. I know you got a Christmas account there, John, with securities to deposits, the amount of bonds and stuff on the balance sheet as compared to deposits. It's a ginormous 70%, 70. At M&T Bank of Buffalo, which is widely regarded as the mother of all quality regional banks, it's 17%. So you compare 70% with 17%, and that shows how odd this bank is.
And not just that ratio, Tom. I think the bigger point that a lot of analysts would make this morning is the lack of diversification behind that deposit base. When you specialize in something quite volatile that's getting hammered by higher interest rates, whether that's the crypto universe or VC
we haven't even mentioned that. But
that's the point that Mike Mayo and others are making this morning.
To me, they're separate, but as I said before, this is an idiosyncratic hat trick, and I'm in the camp with Cassidy Mayo, Davide Serra, and I believe our guest is coming up. You know,
you going to get to our
simple.
guest?
I'm going to get to our guest.
Cool.
I'm just looking at the news flow coming in on this, and folks, stay with us even through Jobs Day here in 2 hours. Philip Richards joins us now with Bloomberg Intelligence in Europe. Philip Richards, just as simple as I can, I know it's not related to European banking, but what's on the balance sheet of European banks?
Yeah, I think it's a very fair question, because I think some of the comments you're making just now in terms of what are the risks and who's next. I think it's natural that if a bank gets into trouble, the market reaction is who's next, and you have to look at the assets they're holding. And certainly, if you look at the European banks, their direct exposure to the positions of Silicon Valley Bank are essentially zero. They're not in the venture capital markets in California. That said, though, the reason the banks are being sold off a bit, down 5 or 6%, is because you think, well, what other assets have they got? Where else can there be these unrealized losses? And for the banks, that's essentially the 1.6 trillion of sovereign bond holding.
I look, Philip, at something Jean-Claude Trichet told me years ago, which is the diffusement of finance across Europe. John Farrow's made it clear to me mortgage rates are different in Europe, inflation's different, utility bills are different. Do higher interest rates diffuse more quicker, more sooner, more rapid to European banks?
I think it depends which banks you're referring to in Europe, because they are a very diverse bunch across from UK to Italian banks. I think what matters for these banks, as I just flagged earlier, is about this sovereign debt holding. So the holding issue of bonds by the governments across Europe. But of course, when interest rates are rising very aggressively, like we've had over the last 6 to 12 months, then the price of those bonds goes down. So therefore, the banks, if they're holding those bonds, they will get unrealized losses on their balance sheets. And that's the risk for the banks people are looking at.
There's a profit story here as well, Philip. The headwinds that these banks might face now, net interest margins that might have to be reduced, the competition for deposits. Philip, how do you see that playing out now, given the news of the last 24 hours?
I think it's very true. I mean, we're in a sector now of European banks which are up about 40–45% over 6 months. So we've had this huge rally. And that's probably why there's been a bit of a, not so much panic, but quite sharp reaction to the news, and almost unrelated news. They're down about 5% or so in Europe. But it's mostly a case of, okay, we've had all these big interest rate rises, huge increase in net interest income for the banks. Now, what will be the risks? What happens next?
Have we ever seen this before in terms of how quickly banks have had to increase the rates that they're paying depositors? And I say this at a time when it's difficult to understand the volume of new loans that can capture the higher rates that can add to the profitability that we were just talking about.
No, it's exactly the case. It's just about how quickly they can pass on those rises. What's happened so far, actually, the banks have not been passing on enough of those rate increases to savings people's balances, and therefore there's been a bit of a political uproar going on in Europe about why the banks are holding on to themselves. But of course, over the next few months or so, that'll be exactly what's happened. The banks are forced to pass on much of these rate rises to the banks. And we are concerned now about liquidity as well. The banks will want to hold on to their their deposit bases. So again, it'll lead to increased rates even further. And that all hits, of course, their top line.
Philip, this was smart. Thanks for being with us. Philip Richards there of Bloomberg Intelligence on the latest. Thank you, sir. Again, drawing that distinction between the existential challenges that some of these banks face, like SVB Financial Group, and that's playing out quite clearly in the last 24 hours, particularly again this morning with the stock down in the pre-market by 42%. You could be right, Lisa, to say that it's idiosyncratic. It would be wrong to say there wasn't a broader challenge here, though, on the profit front. To your point a little bit earlier, people have been very bulled up, these banks, because of this hiking cycle, and now we're at a point where that starts to inflect in a different direction.
And right now, that's what really Gerard Cassidy's point, that raising rates are great for banks that have cheap capital. That is that real crux of the issue, and cheap capital comes from a really solid deposit base. Right now, we're looking at the potential for profits getting eroded at a time where I don't understand how many loans some of these banks can responsibly make to capture the higher yields. And that, to me, is the question. How much can you increase credit card loans? How much can you increase risky corporate credit, especially if that company is facing a recession and really high interest payments?
We've got to talk about the policy challenge confronting the Federal Reserve now as well. I mean, wow. Can you imagine if Chairman Powell had day one of testimony on Capitol Hill this morning off the back of a hot jobs report? This completely changes things, doesn't it?
Well, does it? And here's the question, right? If it does change things, if you end up with a Fed that doesn't raise rates as quickly, then do you end up with more persistent inflation, but a more solid financial system? The Fed put has a lower bar to come into play.
Rock and a hard place.
Yes.
They're in a rock and a hard place now. I wonder if what we experienced in the UK, Tom, was a taste of things to come. Back in September, was it? September, October time, the challenges the Bank of England had to confront. If you face the risk of needing to comfort financial stability concerns at a time where you have to address high inflation, it's a little bit problematic, and we saw that how that played out in the UK briefly.
And it was predicted by a number of really smart people. What played out in the UK was a strategy that ran amok because of interest rate changes, and everybody knew the strategy would run amok if there were interest rate changes. John, some of us that are fossils harken back to the early 1980s, middle 1980s, where 32% of savings and loan associations failed in America. And yes, that was like Jimmy Stewart in the movies of long ago. I can't emphasize enough how these are idiosyncratic shops, but to Lisa's point, do they redound over to the other banking system? And the focal point is that the institution that's watching this is the Fed. This is not SEC. It's not, the alphabet soup that's out there. This is on Chairman Powell's shoulders, the part we never talk about.
There's also this issue of what does safety mean? What does defensive mean in a market that's been reshaped by higher rates? And people had come on the show and said it was the big banks. Does that change with a different profitability kind of equation?
Keep going back to the Treasury market move yesterday just to see the 2-year yield down 20 basis points.
I mean, you go to what's safe and then you expect the Fed to move as a response.
Part of the story, a small part of it was jobless claims coming in above 200K for the first time in 8 weeks. A small part of the story, and we saw the move after claims, didn't we? It existed, it happened, right? We agree on that?
Okay,
then later in the afternoon, clearly there was a much bigger move coming into payrolls off the back of this story. Payrolls coming up in a couple of hours' time. Gerard Cassidy of RBC is coming up next.
governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Live from New York City this morning. Good morning. What a week. Equity futures right now down a third of 1% on the S&P 500. On the NASDAQ, we're basically unchanged on the NASDAQ this morning. Futures going absolutely nowhere there. I'll get to the move in SVB in just a moment. In the bond market, we have been all over the place. Let's take a look at the 2-year. 482.43, down 4 or 5 basis points this morning, down 20 yesterday. Earlier in the week, higher this cycle. The highest since we've seen it, going all the way back to 2007, 5.08%. That was 2 days ago. 2 days ago. It's 26 basis point move lower going into payrolls. That is unbelievable.
This is unheard of, John, and I have this up. I don't know if you've got the banner there, but it's really important. We had something really odd happen overnight in all this carnage. The 2's10 vanilla spread disinverted. It's less of an inversion. And at the same time, the longer range and shorter paper 3-month to 30-year continued to record inversion. I've never observed that. That's a delinkage here, and that was the flight to quality that you saw last night among 3-month paper.
Well, I'd go one step further than that, Tom. I think that Chairman Powell earlier this week lowered the bar for 50 basis points. This event yesterday raised the bar for 50 basis points. There is a belief that the Fed has to back away, which is why we saw a massive move at the front end of the curve yesterday.
I agree, and I thought of this coming in this morning. What do the dissents do? Do you all get on board with Chairman Powell to remain unified, or do you show the debate that's going on at the table?
Steve Englander sat there of Standard Chartered. Would he say they're lighting candles hoping that you don't get a repeat of the
No,
data?
that's
I mean,
correct.
That is true this morning. They're sitting there hoping that doesn't have a 3 handle, a 4, maybe it has a 1, and we could sort of not talk about 50 basis points again, and let's see how this plays out. I want to see how this plays out. So here's Silicon Valley Bank, SIVB, SVP, take your pick. We're down about 44% in the pre-market, just adding to the losses from yesterday, Tom. Yesterday at the close, this bank was down hard, down 60% in yesterday's session.
And for Global Wall Street, it is idiosyncratic, or so they hope. Our team has worked overnight to bring you the best of Global Wall Street on banking, and we begin strong this morning with Gerard Cassidy, head of U.S. Bank Equity Strategy at RBC Capital Markets. He counted banks on Thursday in the savings and loan crisis of who would go out of business over the weekend. You know, Gerard, I mentioned the S&L crisis of the 1980s earlier. This is not this. What is this? If it's idiosyncratic, how do you describe it?
Tom, thank you for having me on. And you're so right. This is not what we saw in the S&L crisis at all. As you remember, Tom, back in those days, it was a credit crisis. This is not an issue with credit at all for Silicon Valley or for any of the banks. But you're bringing up a very good point. What has happened here is the deposits. Everybody is very concerned about deposit outflows. As you guys know, during the pandemic, because of quantitative easing, the Fed pumped in over $3 trillion of deposits into the banking system, and now they're starting to leave. These wholesale deposits, or surge deposits as they're often referred to, are the deposits that are likely to leave. But again, the system has too many deposits, if you can believe that. But the core issue here is we need to focus on core deposits. These are the small denominated deposits. I like to call them grandma and grandpa deposits. Those are very sticky, and those are very difficult to grow because it takes years to gather those deposits. The banks with high concentrations of those deposits, Bank of America is a good example, Fifth Third, Regions Bank, those deposits are sticky, and there's not going to be any real concerns about those deposits.
Gerard, is this a moment to acquire shares in Quality Banking? Can you use the opportunity of the last couple days in crypto and in Silicon Valley to go strong with small banks that you're noted for, or dare I say even the money center banks?
Tom, absolutely. And the reason being is that we understand how fearful it is and the uncertainty out there, no doubt about it. But when you come to core banking businesses that the regional banks do, the community banks do, and the money centers, it's a very strong, stable business. There's no real systemic risk here. And when the stocks sell off like they did yesterday, it is a buying opportunity for the long-term investor. Also, the traders, of course, can get involved, the hedge funds and so forth. But we don't see this as a systemic crisis, nothing compared to 08, 09, or 1990, or the S&L crisis, Tom.
Jared, just because it's not a systemic issue for some of these big names, and a lot of people listening will agree with you, does not necessarily mean it's a buying opportunity. And Jared, you know where I'm going to go with this because you and I have already gone back and forth on it. There is clearly a profit headwind emerging for these big banks. I understand that they don't have the diversification issues, a very concentrated deposit base at a bank like SVP. I think we all understand the unique nature of what's developing in the last 24 hours. But Jared, there is going to be a competition for deposits. And I think what we're all trying to understand are what are the profit headwinds that are emerging here? What are we seeing signs of? Particularly with, was it KeyCorp earlier this week, talking about deposit betas and the risk around that, Jared? Can you frame that for us and what it means for the profits, the bottom line of these banks?
John, you put your thumb right on it. We held our 27th annual financial conference this week, in which Key, to your point, lowered the guidance on their net interest revenue growth because of higher deposit betas. So what's happening is consumers are moving into more higher rate deposits, which is squeezing the margins as we go forward. We expect net interest margin for the industry to probably peak in the first quarter or second quarter of this year. So there will be that pressure or headwind on the margin, but we have to remember banks can still expand their balance sheets through loan growth depending on how the economic outlook is. So net interest income growth, which last year was spectacular, we still see for most banks anywhere from 8 to 10% top line growth in net interest income, even with the margin coming down because of earning asset growth, and that will help them. We still think this year the banks as a group will be one of the few groups that put up EPS year-over-year growth as we see 23 today.
Gerard, I'd want to build on that. This idea of growing their loan books at a time where we potentially could be facing some serious headwinds. And also, a lot of companies aren't going to want to borrow at the rates that a lot of these banks are going to offer. I mean, how fruitful are they going to find the lending market? How risky are the assets they're going to have to lock themselves into in order to capture that higher rate?
It's a really good question. Now, in our forecast for 2023, we do expect loan growth to slow. History has shown the industry's loan growth will grow with nominal GDP. So if you expect inflation this year to average, let's call it 3 to 4%, we have 0% real GDP growth, or maybe slightly negative, you look
Square came out and said that the failure of SVB could destroy an important longer-term driver of the economy because of the VC component of the economy, and recommends that if private capital can't provide a solution, a highly dilutive government-preferred bailout should be considered. Thoughts, Gerard?
I think that's premature. When you look at Silicon Valley, though it's important to the Silicon Valley area, obviously the country and private equity, they're not the only players there, of course. And as you know, our biggest banks are involved in lending into the private equity business. So single-handedly, Silicon Valley, it's important to that part of the business, but it's not the only bank that has that have PE customers, private equity customers, or venture capital. So I think it's a little premature to be saying that at this time.
Joe, when Bramo says thoughts, Gerard, it means that she has thoughts, but she's really trying hard to bite her tongue and not say what she really thinks.
I was
about
really
what Ackman had to say.
I was wondering what he wanted.
was special.
You know?
That was
Thanks,
special.
Gerard, can you give us a brief answer, please?
I'm going to butcher something Jeremy Irons said in Margin Call all those years ago. Speak to me like I'm a golden retriever. So, Jared, if you can, this is a bit of a blank spot for me. It's just regulation, and I'd love your thoughts on it because I know you follow this stuff really closely. Can you talk to me about the degree of regulatory scrutiny some of these smaller banks have received over the last decade compared to, say, some of the large banks, and the problems that might emerge for the smaller cap banks?
John, the regulators have done a very good job in changing the system compared to where we were pre-financial crisis, as you know, and you just touched on. The largest banks go through a stress test every year, and the banking system has been fortified very strongly since the financial crisis. Now, even the smaller banks, they too go through a very rigorous regulatory process. And so I would say that the regulatory picture and the capital levels are quite strong for these banks. And that's the critical part. When you look back to the pre-financial crisis days, the level of capital in the banking system back then was materially lower than it is today. Same thing with liquidity. All the banks have to measure their liquidity. There's a liquidity coverage ratio that it's called, where you have to measure the amount of deposit outflow over the next 30 days. And in that ratio, you've got to carry liquid assets to handle that. So the liquidity in capital is quite strong. Now, granted, we all know uncertainty creates fear. That's what we saw yesterday. As you guys said in the pre-market opening, we're seeing it again. But as cooler minds prevail, I think things will stabilize and people will realize that this is not a 08, 09, or even a 1990 moment.
If you're listening to this on radio, it means you can't see the view that Gerard Cassidy has out of his living room right now, which is just absolutely depressing. So don't tune in on TV.
He lives.
I mean, what is that?
He lives so large in Maine. The lobster shack down the road is $80 for a lobster roll.
We're doing it all wrong.
That's how large it is.
Doing it all wrong. I say this all the time. I just feel like we're just doing it all wrong. Gerard Cassidy of RBC Capital Markets. Gerard, thank you, sir. On the banks, Tom.
On the banks, and it's who he is, and with Mike Mayo coming up, it's the same way. I'd say Mike Mayo has a reputation with a more larger regional bank and money center bank view. Gerard Cassidy helped invent the bringing to market of not tens, but hundreds and hundreds of small banks. And he has seen many banks, for whatever reason, fail. So when he tells me this is idiosyncratic, I'm leaning forward taking notes.
There is always, Tom, that cynical distrust of what emerges, though, in the analyst community on Wall Street. It would always exist. There are many people sitting at home right now and saying, yeah, right, you would say that. So we've all got some big questions to ask. We're going to ask the same questions to Mike Mayo of Wells Fargo a little bit later. This bank is down another 43% in the pre-market, Lisa.
And it raises some serious questions about who's next. I mean, not to say that there are others that are going to be big banks that collapse, but you got to wonder, is this really the only shoe to drop?
Futures right now, negative about 1/10% on the S&P 500. Got to talk about payrolls at some point. So we'll try and do that. Maybe until 8:32, depending on what it is. Futures are negative about 1/10% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a big gain of 517,000 jobs in January, all eyes will be on today's employment report. Another round of hefty payroll numbers could cement the Federal Reserve's resolve to hold interest rates higher for longer. Economists predict 225,000 jobs were added last month, but there are signs the Fed's hikes are taking hold, with jobless claims rising to the highest since December. Donald Trump is likely to face criminal charges in New York. According to the New York Times, the former president was told he could appear before a grand jury next week if he wants to testify. That's said to be a sign that an indictment could follow soon. And the case has to do with the former president's role in paying hush money to a porn star. In Ukraine, President Volodymyr Zelensky is accusing Russia of deliberately targeting a nuclear power plant. The latest missile barrage knocked out its power for a 6th time. Zelensky called for sanctions